Markets, and we will get all of that data that we were not sure if we would get this week. We will be getting that, so there'll be lots of data to digest. This is what's happening on dollar yen, not far from 150, you'll note, 149.63, still ongoing talk about whether we'll get intervention, and that seems to be a focus, aside from the bond buying that we're seeing from the BOJ. That still remains a focus for markets, whether we get some intervention there. The US 10-year yield, worth noting, given the way we've seen the long end of the yield curve, the 30s and the 10s moving higher, 4.61 is where we trade right now, so we're seeing some selling today, and those yields back up again after Friday. Looks slightly different, a little different dynamic, but this more in keeping with the September picture. The futures picture for Europe then looks fairly mixed, fairly flat. FTSE futures have been looking a little bit weaker heading into the start of the European trading day. Other futures, though, were looking a little bit more positive. So that divergence in mind, let's have a look at what we get for the European equity market picture. And as I was pointing out, US futures have been pointing higher, and they've been responding to the shutdown narrative, and perhaps there's something in that for Europe as well. And we see that the FTSE 100 is actually up by 0.2%, so kind of flying in the face of that futures picture, which had remained a little negative into the start of trade, but it seems like a funny old day in markets. Up by 0.3% on the Spanish IBEX, the German DAX up by 0.4%. So despite what the futures told us an hour ago, we are actually seeing some positivity, perhaps the effects of that shutdown story filtering into the European psyche as well, at least in the short term. You can see some movement in currencies as well. The dollar just a little on the back foot there, but really that's a risk appetite measure, isn't it? And we're seeing money going into the pound and the euro, the Swiss franc gains, which is interesting. And this is what we see on sovereign bonds. So we're back to the story of September, it seems, with bonds weakening, bonds selling, yields going higher. We see that on the UK 5-year. We see it on the US 10-year, as we pointed out a moment ago. We've also been seeing this in Japan as well, with JGB yields going higher and a bond sell-off there, and then that triggering some further bond action from the BOJ. All of that to do with the Tankan survey coming in better than expected, that survey of sentiment for large manufacturers. We do have oil prices going a little bit higher this morning. Brent crude up 0.5%, but actually having weakened a bit, so at 92.67. Let's have a look at the sectors picture, for European equity markets then. Some of the sectors that are on the move. We see basic resources being one of the gainers, energy stocks also gaining. Food is moving a little lower, but not much, actually pretty flat. Travel and leisure, fairly flat. We saw some downside for travel and leisure last week, but a lot of that coming from the leisure side rather than the travel side. We don't see any huge percentage changes here, so not much great movement when it comes to the sectors picture. Overall then, European equity markets up by 0.2%. So we see better mood music, slightly more risk appetite, and a lot of that has to do with US politics. The deal to avert a shutdown of US federal agencies will keep the government running until November the 17th, but may come at a heavy political cost for the House Speaker, Kevin McCarthy. For more, let's bring in Bloomberg's Bill Ferries, who's been tracking this over the weekend. Well, there we go. Averted. Shutdown averted, at least for now, Bill. Are we going to have all of the same theatrics, though, in the middle of November? And what about the future of the House Speaker, Kevin McCarthy, and his leadership?
Right. It's very possible that in just a little over 6 weeks, we'll be having the same countdown to a potential shutdown, with many of the same issues looming over both the Congress and the White House. That remains to be seen. What also remains to be seen is, if that happens, if Kevin McCarthy is still the Speaker of the House. After his deal passed over the weekend, with considerable help from Democrats, at least one of the far-right Republicans who has been an opponent of his for months said that he's going to call essentially for a no-confidence vote on McCarthy's speakership as soon as this week. So there's a lot of questions about whether that would really get through, whether that would have traction. the big challenge that many of McCarthy's opponents have had the whole time he's been Speaker is that there's no clear consensus candidate to replace him. So it would be, that will probably be the next big fight. But again, as you mentioned, 6.5 weeks from now, unless there's a considerable progress made in both houses of Congress, we're going to be facing the same arguments, the same kind of shutdown debate, and the same risks to the U.S. economy.
Yes, and another big fight could loom over funding for war in Ukraine. What are we expecting there? Because it seems that the bill that was passed didn't include aid for Ukraine, and President Biden now putting pressure on the Speaker on that front.
That's right. The legislation over the weekend to keep the government open removed an increase in funding for Ukraine that Democrats had sought. On the other hand, it removed some of the budget cuts that Republicans had sought. That was basically the compromise to get this through the House and the Senate. President Biden and his team have said their priority now is making sure some of that additional aid, they've been looking for $24 billion, that some of that aid makes it into legislation very soon. There's already some concerns in Ukraine and Europe about the fact that that was not included in the legislation keeping the government open.
Yeah, we've seen the Foreign Affairs spokesperson for the European Union speaking about that just this morning. Bill, thanks very much. Bloomberg's Bill Farries with the latest on US politics and funding for the US government. Well, Sam Unstead joins us from the Markets Today blog to take us through some of the top stories that they've been writing about on the blog and we'll focus on today. Sam, thanks for joining us once again. I mean, shutdown dynamics. Again, a feature of markets. Not so much for Europe, it seems, but we are gaining a little bit of risk appetite this morning.
Yeah, well, you just said a moment ago, it's kind of funny old market this morning, and I think, you know, so I don't think this was hugely priced in. I think as almost always with shutdowns, and they are, you know, quite regular, as you come up to the actual day and whether there is going to be a shutdown, some risk is priced in. That's unwinding a little bit today, it seems, but it is one of those markets where there's tiny bits of news all coming together and are pushing markets up, but nothing really driving the overarching narrative.
Yeah, we seem to have been on a bit of a round trip on oil prices. Brent seems to be at 92.60, so it's up by 0.4%, but we're well below that $95 a barrel mark that we were talking about just recently. What do you make of the recent move in oil prices?
I think the signals remain very bullish. Like, yes, it may well dip a little bit further back, but as long as it remains above 90, there remains this kind of bullish sentiment in that market. We talked earlier about the UK and the UK stocks kind of coming back against French stocks. A lot of that is down to oil, so that's something we'll be focusing on quite a lot on the blog as well. But certainly the signals remain that oil is going to continue to rise. And we've got a few key events coming up this week, which may well indeed result in that.
Yeah, we've got an OPEC plus gathering, haven't we? A sort of interim meeting taking place in the middle of this week, so we'll focus on that as one of the things on our agenda. Let me ask you about Bitcoin. We haven't talked about crypto for quite a while, it seems, and that in itself tells you something, doesn't it? It's under all kinds of legal scrutiny over in the US, or certain businesses attached to the crypto industry are. What are we seeing today?
Yeah, I think that fits into that same narrative. You know, this is some risk assets are going up. Bitcoin is very, very much a risk asset, and you're right that in the background of this is the Sam Bankman-Fried trial, and so I think the move in Bitcoin this morning really just fits into with the broader narrative about risk assets being bought, but in the background that's likely to start to take, I think, a much more attention as the week goes on.
Okay, certainly an interesting trial to watch. Sam, thank you very much for joining us. Sam Unstead from our Markets Today blog. You can get plenty more from the Markets Today blog team. You'll find a link to the blog on the Bloomberg UK website, or you can type TLIV GO onto the Bloomberg terminal. That will also take you to the blog page. Coming up later today, we'll bring you an exclusive interview with the JP Morgan Chase CEO, Jamie Dimon. He'll be speaking to us from JP Morgan's Techstars Forum in London. That's at 3 p.m. London time. This is Bloomberg.
race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupied areas and I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress, and somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg.
This is Bloomberg. Welcome back. This is Markets Today. 10 minutes into the European equity trading session, and European equity markets going a little higher this morning. The FTSE 100 fairly flat, but elsewhere picking up some gains, motivated into risk assets perhaps by the lack of a US shutdown. US futures going higher, up by 0.8% now on Nasdaq futures. E-minis up by 0.6. Let's find out some of the movers behind those headlines. Individual stocks on the move with Joe Easton, who joins us with an update. Joe.
So BAE Systems at the top of the screen here, that is the best performer on the FTSE 100 today, up around 2.5% now, as the company is awarded around $4 billion in funding as part of the UK's submarine programme that they're doing with the US and Australia. And that's also benefiting Babcock, a smaller name, but that does supply into BAE and a bunch of other defence firms. So those shares really outperforming here in the UK at the moment. We've also brought up Vestas Wind Systems over in Denmark. Now, over the weekend, they got a number of US orders, and there's a note from Sidbank saying that their US orders are now at the highest level in 4 years, around $5 billion in total orders for the company in the last quarter. That one rising there after some declines, getting a bit of a second wind, I guess. That's probably the worst one yet. But United Utilities, now that one at the bottom there, but gaining. They've got a trading update. We had a couple of trading updates last week, including Severn Trent, United Utility in the UK utility space, UK Water, adding to the positivity there. They will actually increase their spending in terms of their CapEx, but their trading looks pretty strong, and that one is rising as well. Other stocks in the UK we're going to look at is the home builders. Now, they have gotten some data pretty positive nationwide, saying that there was no sales price decline in the last month's period. Now, analysts were expecting prices to drop by around 0.4% in terms of UK house prices, but it's unchanged for the month. And we're seeing a little bit of positivity in Taylor Wimpey, but still with the concerns around rates. They're not the biggest movers today, but worth keeping an eye on. And then those luxury stocks, we had Citigroup upgrading the European luxury space to outperform this morning, saying the sell-off has gone too far. LVMH ticking up along with the Cartier watchmaker Richemont. Then a quick look at a couple of ratings standing out to me. NatWest is declining. We had that one over in Stocks to Watch. There we go on the screen. Down 1.3%, downgraded at Morgan Stanley. Other ones that stick out, Teleperformance, downgraded at Deutsche Bank. This is a call center company. They say that artificial intelligence is a big threat to their business. A very interesting one, down 2%. couple of other upgrades with Vivendi and Anto, those ones moving higher. Lots out from the analysts this morning.
Joe, thank you very much. Joe Easton from our equities team. I sometimes feel you need a live audience to give you instant feedback on your puns, the good and the bad. Thanks very much to Joe Easton for the markets update. Let's get now to Helen Jewell, CIO for Fundamental Equities for EMEA at BlackRock, who I'm pleased to say joins me here on set this morning. Very nice to have you with us today, Helen. Good to speak to you. So let's start with a sort of big picture, what you're seeing at the moment. You say in your notes ahead of our conversation that you believe the current business cycle is playing out in a manner that differs from the past. What is it that's so different from the past?
Yeah, good morning and great to be here. Thanks for having me. I think there are two key things that we're really seeing. The first is we've still got a bit of a hangover from COVID. It's almost that we want to pretend it didn't happen, we've forgotten about it. But one example of that is in aerospace and defence. It's a sector where we've seen huge amounts of people back flying again, big growth potential, and of course a year where people in 2020 or companies in 2020 just didn't build aircraft, and then suddenly they want the aircraft back. On top of that, you've got sustainability, meaning they want the aircraft to be a lot more fuel efficient. You can't just build an aircraft overnight, so we're seeing a lag from those kind of things. And then you've got the things that are also, from a second perspective, a little bit more of long-term structural changes that we're seeing. So, for example, decarbonisation, a big focus, and also we're seeing deglobalisation. A lot more companies bringing things back more locally, not just because of what they saw during COVID, also, of course, geopolitical concerns. Yeah. But as a result of that, we've got these tailwinds coming through from companies that benefit.
OK, so there's a lot to unpack there. If we focus on the deglobalisation story, are there companies that benefit from that then? Because a lot of the macro conversation focuses on the negatives. We heard from Larry Fink at the end of last week talking about how, he thought that this was going to be really inflationary. But then, there might be companies that will benefit from this reshoring, onshoring, friendshoring, whichever of the dynamics are in play.
No, absolutely. There are a lot of companies that do benefit. So industrial companies who are solution providers, as you bring people and you bring machinery and bring entire supply chains back, they are the companies that will benefit. So there are lots of beneficiaries. AI, of course, is another area, another theme that you see beneficiaries. It's often very easy, and we just heard there from Joe, to talk about the companies that perhaps suffer as a result of these themes. But there are, of course, plenty of companies on the flip side of that. You just need to understand which companies they are and be able to select and choose those companies in portfolios.
One of the themes you're talking about is decarbonisation. I mean, there's a US expression of that, perhaps well supported by some of the policies that we're seeing stateside. Is there a European expression of that? Is it all happening in the US that's exciting here on that front? Where do you focus?
We focus in both. I think what we're seeing is in the US, it's been a little bit more defined exactly how that will work and how the incentive structure will work. But there is a lot in Europe as well. And it's also important to remember, it's not just about the capital that's flowing in, it's also about the second and third derivatives of that. So even if you're not a direct beneficiary of, for example, the European equivalent, the net zero of IRA, you're still going to be a beneficiary if you are a European company who can help solve for decarbonisation and moving towards a transition environment. So plenty of opportunities both sides of the Atlantic, but I would say the US is probably a bit more defined in terms of how they're going to deliver it.
So for Europe then, Helen, I'm thinking about this because we've just got the manufacturing PMI number for Spain in this case, but we're waiting for plenty of others to come through. But the Spanish manufacturing PMI rising to 47.7 versus 46.5 in August, so still in contraction, but better than it was. I mean, is the decarbonisation story, is that one way for Europe out of the sort of doldrum that it finds itself in? It's a bigger picture story than that.
Yeah, I mean, it is one way out of it, but I don't think it's a complete doldrum story. I mean, you're absolutely right. If you look at earnings forecasts for the year are pretty much flat, 0.6%. But there's some really interesting opportunities if you look at the split between some of the sectors. So, for example, discretionary up 26-27% in terms of earnings versus those on the other side. So, yes, industrials, net zero is one way out of it, but we do see other opportunities as well. Consumer discretionary, European banks. Interest rates are going to be very interesting to see how those play out. And they're a great returner of capital as well. So plenty of opportunities in Europe, even if you look at the consensus from a flat perspective, it doesn't look necessarily quite as exciting.
So you think even if we go into tougher times economically, that's not necessarily bad for banks because interest rates remain elevated? Is that the story?
Exactly right. And again, we've already heard this morning, it's about that play with the net interest margin, so exactly how much they need to actually give that away in order to keep hold of deposits. But the amount that these companies return from a capital perspective is something, as investors, we have to keep an eye on as well.
Another sector that returns money to investors is energy, oil. And I'll ask you about oil. We just got a red headline across the Bloomberg in the last 10 minutes or so saying that an Iraq-Turkey oil pipeline is to start operating this week. This is just, one of a number of supply stories that we're watching. The big supply story, though, of course, over OPEC Plus and what they've decided to do. That's seen as supporting oil prices for the moment. How much of a concern are higher oil prices? I mean, you can play that by buying oil names, gives you an inflation hedge. But for the rest of the portfolio, does it offer real concerns around inflation?
Yeah, of course. I mean, we always have to keep an eye on that oil price. It's incredibly important. It's incredibly important both in terms of where it goes for inflation and then the knock-on effect to interest rates. Is also incredibly important as an input price for example, the industrial companies, as we've already kind of talked to, which is an area that we think could be really interesting and exciting. But at the moment, it does feel that the oil price is pretty range-bound. On the top, you've got the range-bound as an element of demand, and on the other side, you've got it from a supply perspective. And so those two things are really kind of interplaying. You've got the concerns from one side, meaning that maybe we're not going to go too far up at the top end of the price range. But on the bottom end, if it goes too low, we see them just squeezing on the supply. So at the moment, it feels pretty range-bound, which is a nice, almost safe place to be from an investing perspective.
Albeit in the 90s, range-bound in the 90s. Thanks very much, Helen. Thanks for joining us. Helen Jewell, CIO for fundamental equities in EMEA at BlackRock. Thanks to Helen for her time this morning. Let me tell you what's coming up on the programme. Any CEO says new natural gas has been found in Indonesia and it will power up a new production hub in the region. We'll bring you more of that conversation with the leadership of Eni. Claudio Descalzi joins us from the ADIPEC Energy Summit. That conversation shortly. This is Bloomberg.
Obviously, we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that because, we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women. Like, what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Markets Today. We are 22 minutes into our European trading session, and we have European equity markets increasingly positive as US futures turn increasingly positive. Nasdaq futures up by 0.9%. Relief around the shutdown story, despite the fact that we see yields continuing to move higher this morning. Let's talk energy. The Italian energy giant Eni has discovered natural gas in Indonesia in a block close to existing facilities. The CEO, Claudio Descalzi, says the new resource would allow for a new production hub in the region. He spoke to Bloomberg's Yusuf Gamal Eldin at the ADIPEC Energy Summit in Abu Dhabi.
In Indonesia, yes, I think that it's a big hit. We made a big discovery.
How big was the discovery?
The discovery we're announcing, the discovery is the well discovered 5 TCF plus, so in the range of 150 billion cubic meters, plus 400 million of condensate. Is in a good area, is close to our facilities, is close to other structures that we discovered in the past for additional 5 TCFs. Overall, we have about a 10 TCF that allow us to open up and build a new hub. We have already John Creek, that is a big one, a new hub in the area. We are in Kutain Basin, East Kalimantan, very close to Bontang, the LNG plant, and very close to the good market, China, India, Vietnam, South Korea. So it's really a huge discovery that we made a few days ago, we can say.
Yeah. I mean, you're clearly making quite a few breakthroughs, so that leads to the other question around whether there's enough upside to potentially justify a revision of the 3.5 billion euro buyback guidance. What's your feeling at the moment?
I think that, the situation from a balance sheet point of view is good. I cannot talk about the third quarter because we have to announce in a few weeks. But as for the first quarter, second quarter, the trend of prices and also the trend of refining margin are very good and justify the buyback. Now we are still at 2.2, clearly, not 3.5. That is the maximum range.
Yeah.
And that depends on the free cash, depend on the cash flow from operations. As you know, we have a dividend policies, dividend buyback that is linked to the cash flow from operations. So we have each quarter we have to control where we are and then apply our policy.
That was the CEO of Eni there, speaking about the company's natural gas discovery in Indonesia. Let's just check on oil markets for you. We have Brent prices and WTI prices a little bit firmer this morning, 92.54 on Brent. That's where we trade, 91.21 on WTI. So we're moving a little higher this morning. That after we've been higher than this, of course. We were talking about $95 a barrel just last week. Interesting news lines coming through on energy in the last half hour or so. The Iraq-Turkey oil pipeline is said to be ready to start operations again this week, this according to a Turkish minister. We're also hearing comments on OPEC Plus's policy. According to the UAE's energy minister, OPEC Plus currently has the right policy. And middle of this week, we will get that interim meeting, that staging post meeting from OPEC Plus. So we'll look for any news lines there. Of course, the real supply story around Saudi Arabia right now. From a demand perspective, we'll watch China, watch the US. Will we head to $100 a barrel? That seems like the conversation of last week. Citi now talking about heading to $70, expecting the low 70s in 2024. So there's a lot of different views out there when it comes to oil prices. We'll get back to the UK politics shortly. We'll be speaking to the head of policy for the City of London. Chris Hayward will join us from the Conservative Party conference. What does he want from the current government? What kind of policy initiatives is he focused on? This is Bloomberg.
of the focus and the breakthroughs were because a lot of these research labs, the OpenAIs, Anthropics of the world, DeepMinds, had this focus on AGI, artificial general intelligence. Can you build an AI that can do anything?
Yes.
And it turns out maybe you can. So
making a machine that's in our own image, in a sense, that's what AGI sounds like.
More than that, it's a general intelligence. So it's the kid that made you look bad at school because he was good at everything. You know, the top performer.
Right.
Like GPT-4 now can pass the bar exam, the medical licensing exam, the GRE. It's probably going to Stanford, you know, next fall. But then our take was, that's great. You can have these amazing giant general models. What will be better is to mimic humanity, where our companies are not one generalist doing everything. What if we made it so you could bring your own data to the models and have lots of specialists working together and have those models working for you that you own?
Right.
These models like really talented graduates that occasionally went a bit weird. It's called hallucinations or other things, but that's because we feed them bad data. So we were like, what if you had open data, open models, and allowed it to be customized and specialized? So again, like a talented graduate, and they can learn very quickly from a few examples. So they have this base of generalized knowledge. They've been through kindergarten, high school, and university, but they're not specialized yet. But you can train them yourself, or you can just show them some examples, and they learn very quickly.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
This is Markets Today. We're 30 minutes into your European trading day. Here are your top stories. European indices kick off the quarter in the green, while US futures gain, with markets upbeat after Congress reaches a deal to delay a potential shutdown in Washington. The BOJ announces another bond buying operation this week as yields hit a new decade high. Plus, taxing times for Rishi Sunak, the UK Prime Minister's Chancellor, tells Bloomberg the government doesn't have headroom for tax cuts, setting up a potential standoff with some senior colleagues. Let's check the markets for you then. Half an hour into the European trading day, and this is what we have. We are stronger across the European equity markets, up by 0.5% on Stocks Europe 600, DAX and FTSE futures, both a little firmer this morning. The shutdown narrative lifted in Washington at least until November 17th, adding some respite for US futures, which are going higher. Do we then have to focus in on higher yields, though, which also seems to be a feature of this morning's session? More on that shortly. Let's take a quick look at the sector picture, and this is what we have around sectors. Last time we checked in on this, we weren't getting any great clues as to what was going on the sector picture. There we go. They're all green. I suppose that's a message in itself. Up by 0.8% on retail. Consumer stocks doing well, up by 1.2%. Overall, as I say, modestly stronger across European equity markets this morning. Let's get to the UK Conservative Party conference. It's taking place in Manchester early this week. Bloomberg's Lizzie Burden is there with another guest for us. Lizzie.
Thanks, Anna. I'm here in Manchester with Chris Hayward. He's policy chairman of the City of London. Chris, glad you made it all the way to Manchester. Of course, there are strikes happening.
Indeed.
What's your take on the mood here?
Well, I think the mood here is one of anticipation and expectation. What we're interested in seeing is what the Conservative Party is going to put forward for the next manifesto, what their commitments are going to be, how we're very keen to see economic growth coming forward. We brought a paper forward to actually recommend to politicians of all parties some of the big moves they can make to get economic growth into the system, and we think that that is the future. So I think the mood is one of anticipation, hopefully optimism, and we'll see particularly what the Chancellor has to say to us this morning.
On that growth point, Bloomberg understands that the Chancellor's planning to copy Canada's growth fund to try and boost investment in green tech especially. How much money would the government have to inject into that to make it a success?
Well, look, I don't have the figures the government have got available to me, but what I can tell you is that green tech and green finance in general and sustainable finance are fundamentally important to growing our economy. And particularly in the City of London, you know, we are a centre for green finance. finance, for thought leadership, for green finance products, and that's a really, really important part of driving that growth agenda.
When I was speaking to the Chancellor, Jeremy Hunt, who was stood just where you are a few minutes ago, he refused to commit to tax cuts, at least not before the next election. What would you like to see in terms of tax cuts for the city?
Well, look, as far as the city's concerned, and particularly the banks, our banks pay the highest tax of any country. And what we want to see is a move in an affordable way to an internationally competitive tax system. And that's going to take some time. We understand that. We can understand why the Chancellor can't commit to tax cuts at this moment. But we do need to see an internationally competitive tax system. Otherwise, our banks and our financial institutions are at a major disadvantage to their international competitors.
One of the controversies looming over this conference is the government's reluctance to commit to the northern leg of HS2. Some Tories themselves are saying that that would shake foreign investors' confidence in Conservative promises. Is that the read you get?
Well, look, the way I see HS2 is that infrastructure is very important to driving jobs all over the country. We're a sector in the financial services sector that employ 2.5 million people across the country, and 2/3 of those are actually outside of the City of London. But of course, it's got to be considered in an affordable way. So, you know, the government have to decide whether it's affordable to continue to do it, but the principle of infrastructure investment is one which I would support very strongly indeed.
And you yourself have mentioned green policies. Some of the world's biggest green investors have voiced their bewilderment over what seems to be the watering down on net zero by the Prime Minister. Do you share that dismay?
Look, I don't think the Prime Minister is watering it down. He has said that the targets remain. He's just moved some of the elements of the timing around those targets. So I don't see this as watering it down. I think this government, and I believe this party, is as committed to the green agenda as they've ever been. But what we do need, and I say this all the time to politicians, is we need continuity and clarity of policy, because businesses are making investments based on those target dates, and they need to know where they're going.
The numbers, the latest numbers, suggest that actually London's on the cusp of becoming the biggest stock market in Europe again. We lost the crown, of course, to Paris. Does it feel on the ground like we are getting back to that turning point?
I think we are, and I hope we can, because it's fundamentally important that London is the global financial capital of the world, as far as I'm concerned. That we've seen IPO listings deteriorate over recent years on the London Stock Exchange. I'm very keen to see those come back and to see us actually being the thriving capital centre for finance of the entire world.
And finally, Chris, Liz Truss, the former Prime Minister, is making a speech later today. Are you going to be attending?
I'm afraid my diary doesn't allow me to do so, but I will be very interested to hear what she's got to say.
Chris Haywood, Policy Chairman of the City of London. Brilliant to have you on Bloomberg TV.
Thank you.
Anna, back to you.
Lizzie, thanks very much. Lizzie Burden with the City of London Policy Chairman. Thank you very much for bringing us that conversation. Coming up on the programme, so the US has averted a government shutdown for now as hardline Republicans seek to oust House Speaker Kevin McCarthy. There seems to be lots of questions still hanging over US politics. We'll get to that conversation. Thomas Gift joins us from University College London with his insights into US politics. This is Bloomberg.
Was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Markets today. We are 39 minutes into the European trading day, and we are stronger across Europe, up by 0.4% on the stock 600 as US futures push us a little bit higher. No US shutdown. More on that shortly. Let's get to some of our other top stories that are crossing the Bloomberg terminal this morning. The billionaire Bill Ackman is reportedly interested in pursuing a deal with Elon Musk's X Corporation as part of a new investment vehicle. Ackman's investment fund, Pershing Square, has regulatory approval for a new investment vehicle that targets private companies seeking to raise $1.5 billion or more. He told the Wall Street Journal that X is absolutely one of the options he's considering. Lawyers for the French billionaire Bernard Arnault say allegations of possible money laundering are, quote, as absurd as they are unfounded. The Paris Public Prosecutor's Office confirmed the investigation on Friday. According to Le Monde newspaper, the probe is related to property in the exclusive ski resort of Courchevel. UBS has reached a settlement with Mozambique over Credit Suisse's role in a ship financing scandal. The undisclosed settlement closes a decade-old case which initially saw Credit Suisse financing the construction of a new coastal patrol force and tuna fishing fleet for Mozambique. The African nation has alleged the Swiss bank ignored red flags and the corruption of its own bankers' bond deals. The deal to avert a US shutdown, a shutdown of US federal agencies, will keep the government running until November 17th. But that may come at a heavy political cost for the House Speaker, Kevin McCarthy. Let's get some analysis now. Thomas Gift joins us, Director of the Centre of US Politics at University College London. Thomas, very nice to speak to you this morning. So clearly the pressure removed in the very short term. We're not sitting here with a shutdown ongoing in the United States. We've kicked the can, if you like, to November 17th. Will we face just exactly the same dynamics then? Has anything fundamentally changed?
Well, I think you hit the nail on the head, which is nothing has fundamentally changed. A continuing resolution essentially just pushes this decision down the line, gives both sides a little bit more time to work out some of their differences. But, the fundamental fact remains that Democrats and Republicans really aren't close in terms of the basics of the negotiation. That especially includes funding over Ukraine, but a whole host of other issues, particularly with regards to the Freedom Caucus and their demands for much steeper cuts. So I think it's very likely that we are just in this situation in 45 days from now, talking about the exact same thing.
Thomas, what do you expect to see on that funding for Ukraine? Because $6 billion of funding for Ukraine's fight against Russia, defense against Russia, was not included in the bills that were passed, much to the alarm of President Biden and some European leaders who've been already speaking about the subject. Would you expect ultimately that this funding is secured in the US?
Well, I think that the funding is probably going to be secured, but I'm not sure if it's going to come through this legislative process. What we're seeing really is an even harder pivot away from Ukraine aid among some House Republicans. I think skeptics aren't just saying no more blank checks. They're actually accusing opponents of pushing an agenda that prioritizes Ukrainian interest over American interest. And I think that the more the war drags on and the more these budgetary battles drag on, the more that feeling seems to be catching on inside the Republican Republican Party. So supporters of funding Ukraine will continue their lobbying, and I think that there are ways to get financing. But for critics of assistance, this last week really saw two major victories for them. The first is the fact that this continuing resolution excluded $6 billion in funding to Kyiv, and the second is that nearly half of House Republicans voted to take away $300 million from a defense spending bill that would train Ukrainian soldiers and help to buy weaponry. That eventually passed, but it didn't garner the support of Republicans initially. So I think the fact also that happened on the heels of Ukrainian President Zelensky's meeting with legislators in Washington just about a week and a half ago to try to shore up U.S. support. The fact that, Republicans aren't sort of getting behind that, I'm not sure if it bodes particularly well for increased financing.
But on the broader question of whether there still is majority support for backing war in Ukraine, backing the Ukrainian side here, is that really in question, Thomas, or is this just very loud, vocal, empowered voices on this particular piece of legislation who actually, if this was just about Ukraine, would not hold sway?
Well, I think there's a sharp division between the House and the Senate. If it was just about the Senate, then there is broad bipartisan support. The House, I think, is a much different story. You certainly have the right wing that is very skeptical of financing. And then I think you have sort of it's hard to know exactly the number, 50 or so Republicans, I think, that could go either way, probably don't want kind of full levels of financing that they would like to see in the Senate, but probably want to give some to it. So I think that then just becomes sort of a battle about how much and not if.
Okay, on to some of the personalities involved here, I suppose, Thomas, for want of a better word, or the actors here. Kevin McCarthy, his future. What do we make of where his future goes from here? We've got Matt Gaetz, the Florida congressman, Republican, of course, says he's going to file a motion this week against him because McCarthy had to rely on Democrats to push this funding deal through. What do you think is the future for Kevin McCarthy, given that kind of language, at least?
Well, the language certainly is threatening. Personally, I think that McCarthy's position as Speaker is a little bit safer than many do, and that any motion to vacate that position is unlikely to pass. For one thing, it's hard to objectively look at McCarthy's record and say he's been wholly ineffective. I mean, just go up and down the line. He secured the Speaker's gavel in the first place, which was no small feat. He helped to raise the debt ceiling, and now he avoided a federal shutdown, even if temporarily. Obviously, a lot of the right wing of the Republican Party aren't happy with how he did it, but he did it. And at the same time, I think no one can say that McCarthy hasn't tried to placate the right-wing members of his conference. McCarthy, to my mind, is maybe a savvier operator than he's often given credit for. The bipartisan compromises he's reached and the attempts to find common ground with Democrats don't sit very well with some member of his party. But, it's a tricky political situation. I think the reality needs to set in that Republicans aren't going to get everything that they want. There's an opposition Senate. There's a Democrat in the White House. Plus, the big obstacle with ousting McCarthy is that there's no obvious replacement. I think that that's no small issue. It's not as though the Freedom Caucus is all rallying around one clear successor. So for those reasons,
right.
I do think McCarthy is going to survive here.
And Thomas, as we look ahead then to November 17th, it's really not that far away. Are there pieces of legislation that you think are just not going to be approved, not going to be voted on, not going to get through, as we see US government once again having to focus on these shutdown threats? What is not going to get done as a result of all this?
Well, I think basically nothing is going to get done. I mean, that's sort of been the watchword of Washington over the last several months, because we're in divided government generally. So I can't imagine any major pieces of legislation getting pushed through. That's particularly the case not only because of this budget deal, but also because what Republicans have been trying to do on the impeachment front. And so, I think we're just in for a lot of stalemate. What I'm really watching is how these negotiations unfold. If there's any way that Republicans and Democrats can reach an agreement before the 11th hour again, I'm really skeptical. I think that we're just heading right up until the brink.
Okay, Thomas, thanks so much for joining us. Thomas Gift, Director of the Centre for US Politics at University College London, joining us very kindly from the US at this early hour. Let me get to the European breaking news stories from a macro perspective. We've got Italian PMI just breaking. September manufacturing PMI, this is, rising to 46.8 versus 45.4. So just as we saw with the Spanish number a little earlier on, we have a number that is better than the previous month's reading. That not doing too much to support the euro. You can see the euro is a little stronger this morning, but fairly flat against the US dollar. The dollar has been, was earlier in retreat against various currencies as a result of risk appetite, but right now we see it flat against the euro. Coming up, with the US shutdown no longer imminent then, markets are focused elsewhere, including jobs data, which we will get this week. That wasn't certain at the end of last week. We will discuss what to expect. That's next. This is Bloomberg.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Since the spring budget, our debt interest payments have gone up because the markets are pricing long-term debt more expensively than they did. But there's another reason why this isn't the right time for big tax cuts, which is even more significant, which is that they would be inflationary. If we put money in people's pockets, they would spend that money and then prices would go up. And just at the moment that we're turning the tide on inflation, we wouldn't want to go in the opposite direction.
That was the UK Chancellor of the Exchequer, Jeremy Hunt, speaking to us from the Conservative Party conference in Manchester, talking about turning the tide on inflation and how he will steward the economy with that in mind. Welcome back. This is Markets Today on Bloomberg TV. We are 51 minutes into your European trading day, and the equity market picture actually quite positive. We are more positive than we thought from the futures picture this morning. So up around 0.4% on the Stock 600. US futures also moving a little bit higher this morning. So lots to focus in on when it comes to the fact that there's no shutdown in the United States. Let's just get to some breaking news coming through on the French manufacturing PMI. We've had numbers from Spain and Italy. The French number then showing exactly the same trend, slightly better than the preliminary reading number coming through. So 44.2 is the number we have on French manufacturing PMI. The prelim number was 43.6. So again, improving at the margin. The euro is fairly flat though this morning against the US dollar. Here's what we're watching out for this week. Today at 3 p.m. UK time, we'll get US ISM manufacturing data. We'll also hear from Fed Chair Jerome Powell, who will be taking part in a roundtable discussion. That's at 4 p.m. London time. Tomorrow, there's an update on US job openings, the JOLTS figures. Then on Wednesday, that'll be a busy day, we will be getting US ISM services data. So today we get manufacturing for the US. Wednesday, we'll get ISM services. OPEC Plus is also holding an interim monitoring session. We've heard from the UAE saying OPEC Plus's stance is correct right now. The ADIPEC conference, of course, ongoing over in the Middle East. The ECB President, Christine Lagarde, is also going to be speaking midweek, so we'll focus in on her comments. On Thursday, the Bank of England's Decision Maker Panel survey, that will be released. And to round out the week, we will, of course, finish with US payrolls. Let's talk about some of the things that are going to be affecting markets this week. Eddie van der Veld joins us from our Markets Live team. Good morning to you,
morning,
Eddie.
Anna.
It's Monday morning. It comes around fast, doesn't it, these days? But we're heading towards a jobs report. No sooner, it'll come quicker than we think as well. It'll be Friday.
Yeah,
soon.
well, there was a little bit of relief, I'll have to say, on my desk this morning, just to see that that the government and the US is not actually shutting down, that we are actually getting some of this data. And, that's not just a flippant comment, because if you, in a world where there is less forward guidance, every data point becomes more important. Therefore, if you delay the data, it gives the markets less time to price in, any volatility that they have to, before subsequent meetings from the Fed and so on. So I think it's really important that at least we'll be getting this data early, or at least this week, and not that we won't have to wait until after a shutdown. And there's a lot to look forward to, right? I think if we're looking for things like the participation rate in the US, which has been ticking up, but is just about getting to that level where it was before the pandemic. So can that continue? And what does that mean for interest rates going forward?
Okay, yes, and thinking about interest rates, we've got Treasury yields going higher. In particular, I see the 10-year, actually the 10-year, 2-year, 30-year, all going higher in terms of yields this morning. And it's interesting tying it into what you were saying there, because I think some people went into the weekend thinking, well, if we're going to get a shutdown, the data won't be coming. The Fed will have to go slowly, because if you don't have the data, you move slowly and carefully. And maybe that gave us some relief from the higher interest rate story at the back end of last week. Today, though, we're back to what we saw in September, higher rates.
Yields pushing higher, pushing higher, pushing higher. And what's interesting today is that it's not all at the long end of the curve. In fact, it's the front end yields that's coming up a little bit more, which is the opposite of what we're really expecting at this kind of point in the hiking cycle. I think there's probably some technical factors behind this. I think I would wait longer, before I make a real judgment on whether the steepening trade that we've seen over the last few weeks is done, and whether or not we're going to see the steepening coming via the front end of the curve.
Yeah, we've seen the long end doing its bit. Do we need the short end to do it too? German September manufacturing PMI, Eddie, let's just check in on that. 39.6. The prelim number was 39.8. I mean, we can quibble about where it is versus that prelim number, but it's under 40. These are really weak numbers for manufacturing over in Germany.
It's a pretty terrible number. Europe feeling more and more stagflationary, right? And particularly in Germany, manufacturing matters much more so. In France, you look much more at the services number. But I mean, these numbers are really weak, and we need to see a significant turnaround there. The US still in a much better position than Europe is.
Okay, that's the European manufacturing story then. So just closing out the hour with those German figures. German manufacturing PMI 39.6 against a prelim reading of 39.8. So we knew it was going to have a 30 handle, but still very weak numbers coming through from Germany. In terms of manufacturing, we will build up the data picture, as Eddie says. We'll get that data out of the US this week. We'll get the ISM manufacturing number today. We'll get the services number midweek. We'll get the payrolls number on Friday, crucially. So that will be something something for the market to work towards. We'll also be hearing from a lot of Fed speakers, including Jerome Powell himself, today. How happy will Fed speakers be with the way that yields have been moving? Thanks to Eddie van der Veld from the Markets Live team. More on the markets coming up next. This is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. And market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. European stocks and U.S. futures gain after Congress narrowly averts a shutdown, keeping the government running until mid-November. The UK Chancellor tells Bloomberg the government does not have headroom for tax cuts, setting up a potential standoff with some senior colleagues. Plus, our exclusive interview this hour with the JP Morgan EMEA Chief Executive Officer, Viswas Raghavan. We'll talk about the City of London and technology. Now, let's take a look at some of the European market stocks. Now, this overall is the picture for the European market map. If you look at Euro area September manufacturing PMIs are coming in, also pretty much in line with expectations. 43.4 preliminary was 43.4. So there you go, bang on in expectations. Let's also get to the wall if we have a wall, so that will give us a good indication of what the maps are doing. There you go. As if by magic. Sometimes we're magicians. You can see the CAC 40 actually getting some 0.5%. We're seeing gains across the board, not huge gains. Certainly the FTSE gaining some 0.2%. But remember, it was only 24 hours ago that we were really worried about potential government shutdown in the U.S. The relief rally could be actually quite short-lived, but this is what we have at the moment. Then we also have Citigroup actually with a pretty bold call of, I think, Brent or certainly WTI at $70 a barrel into next year. For the moment, it's gaining quite significantly, 92.34. Youssef Gameldin is on the ground with some fantastic interviews. I think we're also speaking to the Eni chief executive officer. Overall, the picture is basically one of gains across the board. Look, if you look at what we've seen for the Treasury sell-off, so let's get to futures, but then we'll do the Treasury sell-off. The Treasury sell-off that we had seen over the last couple of days is definitely a story of what's been happening with shutdown, and then you can see S&P futures gaining at the moment. This is the year-to-date S&P look ahead. Now, the deal to avert a shutdown of U.S. federal agencies will keep the government running until November 17. It may come at a heavy political cost, though, for the House Speaker, Kevin McCarthy. Now, for more on all of this, let's bring in Bloomberg's Bill Ferry. So, Bill, are we actually going to be having these same last-minute theatrics in November? And what about the threat to the House Speaker's McCarthy leadership?
Yes, we absolutely could be going through this same cycle again in just about 6 weeks. U.S. Congress and the White House have kicked the can down the road in the sense of continuing government funding, but really not extending funding into the fiscal year beyond that November 17th deadline. And another question now, as you mentioned, is whether Kevin McCarthy will be around as House Speaker to even be a part of that fight. One influential Florida Congressman, Matt Gaetz, has said he is calling essentially for a no-confidence vote in the Speaker as soon as Congress resumes this week. It's not clear whether that will go very far. The challenge that McCarthy's opponents have long had is that there's no consensus candidate to replace him. So unless the Democrats somehow decide to swing votes in favor of this hardcore group of Republicans that wants to oust McCarthy, the Republican Party will really be at a standstill for a little while as they try to deal with this challenge to the Speaker's authority.
Bill, thanks so much. Bill Ferry's there with the very latest on the shutdown. Now with us, Sandra Horsfield, economist at Investec Bank, and Tim Craighead, senior European equity strategist at Bloomberg Intelligence. So thank you both for joining us. Tim, that was a bit of a relief. I know we'd gone through the numbers of how much equities would suffer if we were to have a shutdown. Is it just postponed until November?
I think yes, in a word. You know, in many ways, there's the fear factor of a government shutdown because it's a big deal. But from an equity perspective, higher interest rates, the negative implication of higher interest rates on valuation is a bigger deal to me and a bigger reason why both U.S. and European equities have sold off over the course of the last month or two. And in fact, you know, if we had had a shutdown, that bad news could have in fact been good news from an interest rate perspective. Right. And so the reverse, if we have a little positive rally this morning, I think it basically reverts back to an interest rate play, which is going nowhere at this point.
And I want to talk about the economics in just a second, but overall, I mean, this could also be short-lived because we don't know what's around the corner, and there's an overhang of actually the economy and whether the U.S. will go into recession.
No, absolutely. And I have to say, it'd be very interesting to get Investec's perspective. You know, our Bloomberg economists are worried that, in fact, the U.S. is more prone to recession. And from a European perspective, clearly we're seeing weakness. You saw the German PMI numbers manufacturing numbers this morning, which are quite weak.
And Sandra, there's this funny old economy right at the moment. I don't know if it's a technical term, CFA level 5 maybe, but we're still in this like wait and see situation of whether we do see a recession or we just scraped by, but the consequences could be very different.
That's right. I think we're coming from this, from a situation of really resilience in the first half of the year that has taken people by surprise after the huge interest rate increases that we've had. But there are headwinds, and they're quite clear and stark. We have headwinds coming from the fiscal side, not just because of the shutdown debate, but also the repayment of U.S. student loans, which is now kicking in. And that will slow the economy. Just how much relative to the still tight labor market, that's the big question now.
Sandra, on the U.S. shutdown that, for the moment has been averted, what's the read across? So is there more political consensus? Is there going to be a change with Kevin McCarthy, or is it just kicked down the road?
If the story had just been, that's it, there's no shutdown, I think we would have had much bigger market reaction this morning. it does very much look like a kick the can down the road situation, and we'll just have to see what plays out at the end of this. For now, I think everybody's in a holding pattern.
So, Tim, what does it mean for equities that we like at the moment?
So in the equity market, a couple of interesting things going on. Interest rates still stickier from a European-U.S. perspective. The exception has been the U.K. And over the course of the last month, as we've seen the U.S. sell off and we've seen Europe broadly sell off, the U.K. has stuck out quite remarkably, in part because interest rates here do seem to have a pause with a genuine surprise from the BOE. At the same time, oil is ticked up and the FTSE is heavy on oil. And those in combination have helped push down the pound. And you've got foreign earnings that are quite important for the FTSE, more so than most other European markets. So you have all of these coming together that create a favorable wind at the back of the FTSE relative to many other Europeans. And I'd mention one last thing. Don't forget, August and September are historically very poor seasonal months for European markets. October tends to be more neutral. November seems to be quite positive as you start to look ahead. I think a lot of this late summer sell-off could, in fact, just be a setup if we do have a pause in ECB policy at some point because of the inflation outlook improving. It could be quite interesting at the year end across European markets.
And Sandra, I guess no economies are created equal, so we'll talk a little bit more about the UK, but if you look at a stronger starting point maybe for GDP, what does it mean for a likely recession in the UK?
I think in the UK, right now, we are still, again, starting from a strong labour market. We have to bear that in mind. But there are more signs of weakening. Lately, we are seeing indicators of vacancies, which had already been starting to slow, turning more decisively. Unemployment is starting to tick up. So perhaps that sort of pass-through to the economy from the interest rate rises is now starting to bite. We're still looking at a winter recession, not a very deep one. We think that will be averted, given that the improved energy backdrop is there. But it's still certainly a weak spot, we think, that we're entering into.
And so how does it compare with the rest of Europe?
The rest of the euro area, I think, in particular, is quite affected by the manufacturing sector. We see that in the PMIs. They have really suffered, especially where the manufacturing sector is concerned until now. But services are also slowing. We're seeing bank lending slowing in the Eurozone. Yeah. And sort of generally, that's a signal that the economy really is in for a much more of a response to the interest rate hikes. So a deep recession, again, doesn't look likely, but a soft patch, certainly yes, in our view. So some countries, Germany, Italy, perhaps in recession, maybe others will escape it. So a sort of muddling through scenario in aggregate is probably the best.
All right, Sandra and Tim, thank you so much. Tim Craighead there from Bloomberg, and Sandra Horsfield, economist at Investec Bank, stays with us. Coming up, tax cuts would be inflationary. That's according to the Chancellor, Jeremy Hunt. More from our interview next, and this is Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
waking up. Europe is already trading. And Manus Cranny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything.
The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now, here in the UK, the Chancellor, Jeremy Hunt, says cutting taxes now would be inflationary. Ahead of his Conservative Party conference speech later today, Hunt also told us it's uncertain if there will be tax cuts before the next election. Well, joining us now from Manchester, from where the party conference is going on, is Lizzie Burden, who just spoke to the Chancellor. So, Lizzie, good morning, first of all. What were your main takeaways?
Yeah, good morning, Francine. I have to say the atmosphere here is less chaotic than last year when Liz Truss's administration was somewhat floundering, but it's still pretty downbeat here. And it's pretty downbeat where you are, in the sense that our latest Bloomberg Pulse survey showed that the majority of finance professionals reckon Keir Starmer, the opposition Labour leader, would be better at running the markets and the economy than Rishi Sunak. So that's where I started the conversation. Take a listen.
The answer is that we've been through a very challenging period in the British economy, and as people see Rishi Sunak and my plan working, we will start to see those numbers change. And when I became Chancellor and when he became Prime Minister, inflation was over 11%. Now it's down to 6.7%. That's a fall of 40%. We just heard last week that our economy has recovered better than France or Germany since the pandemic, and that's because of the decision that Rishi Sunak took as Chancellor to introduce the furlough scheme, one of the most generous schemes in Europe. And so I think as people start to see that this is a government that is prepared to take difficult, long-term decisions to make our country more prosperous, they will understand that the Conservative Party is the party of wealth creation that will mean in the end we have more money for our precious public services.
Well, speaking of the long term, let's talk about HS2, because we are in Manchester. Your predecessor, George Osborne, Conservative Chancellor, raises the question, how can any foreign investor trust a Conservative promise if you can't make certainty on HS2?
Well, I'm really sorry to disappoint you, but I'm not going to be able to talk extensively about that because we haven't made a formal decision, and at the appropriate time an announcement will be made. But what I will say is that we would always want to invest in our economic infrastructure.
The other big controversy that's looming over this conference is tax cuts. Many of your colleagues say you can't win an election without them. Michael Gove wants tax cuts for workers, but in January you told Bloomberg your priority, when it's affordable, are tax cuts for business. Is that still the case?
Well, I'd like to have lots of tax cuts, and I think that we have already cut business taxes when it comes to, for example, business rates. The £13.5 billion package I announced at the autumn statement is about an average of a 10% cut.
But we've
introduced capital allowances for 3 years, most generous capital allowances in the world, introduced in the spring budget. But to answer your question very directly, if we want faster growth and also an end to taxes ever ratcheting higher, that is possible, but there are no shortcuts. And what I'll be saying this afternoon is if we're going to do that, we have to make it easier for businesses to grow. We have to spend taxpayers' money more efficiently. We need to reform the welfare state. Those are difficult decisions, but they are decisions that Rishi Sunak and I are willing to take, because the choice in British politics is between a party that does want to bring down the tax burden and the Labour Party that doesn't.
So as you heard there, the Chancellor trying to focus on what is called here, it's the slogan, long-term decisions for a better future. But inevitably, the focus is on the short term because a general election is on the horizon. He will not commit to tax cuts yet. He says that they would be inflationary. But he says that they will depend on how much headroom there is, so hinting there won't be borrowing to cover tax cuts, which are what many of his Conservative MPs want. Look, today the headline act is going to be his speech at 2 p.m. The focus is expected to be on welfare cuts and a rise in the minimum wage to try to reduce economic inactivity. The question is, what will businesses do in response? Are they going to raise prices to cover the bigger wage bill? That would be inflationary.
Yeah, a fantastic interview, Lizzie. Thank you so much. It'll be interesting also to say how that goes down with some of his Conservative colleagues that really wanted bolder moves ahead of the election. Now, still with us, Sandra Horsfield, an economist at Investec Bank. Sandra, thank you so much for sticking around. I mean, so many questions on the UK, which is productivity, inflation. Can the government actually reduce inflation? I mean, this is the kind of supply-demand of, food, energy, and what the Bank of England does.
Absolutely. There are certain things that are directly under the government's control. We've seen that with the energy price cap, for instance, and the subsidies that have been implemented on top of what simply market movements would have had. So, yes, those have direct implications, so direct government decisions. Otherwise, it is much more for the indirect stance that takes effect. You said demand is important, so how much fiscal stimulus there is will determine the demand in the economy to a certain extent, and that will influence relative to supply where we end up on inflation. For that, we can't have fiscal policy going in one way and monetary policy in the other. And I guess that was the big concern last year, that we were heading in that direction. Clearly, that's something that Mr. Hunt would like to avoid this time around.
Sandra, what's your biggest concern about the UK right now? So, again, it's a tight, it's a small, tight labour market. It's a very open economy. And I think Mark Carney once said we rely a lot on the generosity of strangers. It's like basically investors, international investors that fund a lot of the UK.
Absolutely, and I think that is one of the factors perhaps that has been holding back sterling for some time now, that we do rely a lot on external funding. It is quite difficult to grow the economy at this point, and indeed the room for making very large investments is limited given the fiscal backdrop that has deteriorated due to one-off shocks that have hit us. Clearly, a pandemic is a big shock, and the response for this was never meant to last that long, but nobody knew. So all of that has, however, ratcheted up the debt level, and that has to be taken into account when setting policy going forward. So the difficulty is how do we sustain, how do we create creations for the economy to grow here?
So first, and this is the main problem, right, is that if you look at a lot of the blueprints, it's unclear exactly what the path forward for growth is. But if you're the Bank of England, is that it, or is there more to come in terms of tightening?
I think from the Bank of England's perspective, they will have been reassured by the latest inflation numbers for a time, and I guess that was the story as we were in the summer. It looked like we were really overshooting relative to their expectations in terms of interest rates. Markets took fright. We had this big spike in rate expectations at some point. People feared we could get to 6.5% bank rate or so to really clamp down on demand. Now we're seeing more signs that the economy is slowing, that the labour market is turning, that perhaps these wage demands aren't going to go up that high. And the Bank of England is hoping that just by holding it steady from here, that will be enough. We think it probably will be. So the higher for longer tabletop mountain approach will probably be the likely one. But it may be only until the middle of next year or so when we could start to see rate cuts coming back onto the table.
So interesting, Sandra. Thank you so much for all of your time today. Sandra Horsfield there, economist at Investec Bank. Now, coming up, we'll have plenty more, not only on markets, but we'll look in depth at treasuries. This is Bloomberg.
Obviously, we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that because, you know, we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women. Like, what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
The boundaries of the entertainment world are blurry, and they're all scrambling for the same thing, screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business, converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at bloomberglive.com/screentime.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
The conversations that matter, the insights you need. This is a Pulse, and I'm Francine Lacqua here in London. Now let's get to some of our top stories that are read on the Bloomberg terminal. And billionaire Bill Ackman reportedly interested in pursuing a deal with Elon Musk's X Corporation as part of a new investment vehicle. Now, Ackman investment fund Pershing Square has regulatory approval for a new investment vehicle that targets private companies seeking to raise $1.5 billion or more. He told the Wall Street Journal that X is absolutely one of the options that he's actually considering. Now, lawyers for the French billionaire Bernard Arnault say allegations of possible money laundering are, quote, as absurd as they are unfounded. Now, the Paris Public Prosecutor's Office confirmed the investigation on Friday. According to Le Monde newspaper, the probe is related to property in the exclusive ski resort of Courchevel. And UBS has reached a settlement with Mozambique over Credit Suisse's role in a shipping finance scandal. The undisclosed settlement closes a decade-old case which initially saw Credit Suisse financing the construction of a new coastal patrol force and tuna fishing fleet for Mozambique. Now, the African nation had alleged the Swiss bank ignored red flags and the corruption of its own bankers' bond deals. And less than a year after losing the crown of Europe's biggest equity market, London looks set to recapture it from Paris as French luxury shares take a tumble. What's the focus of today's big number? It's $30 billion, and it's the gap between the two. We'll have a full roundup of what this means also for the City of London. My interview of the day is probably with Viz Raghavan. He's EMEA Chief Executive Officer for JP Morgan, and it'll be really interesting to get his thoughts on technology, of course on ARM and the fact that they decided to list elsewhere, what this means for the UK and whether there is more of a gap between the UK and also the rest of Europe that's being formed. We'll have plenty more, of course, on the markets. Stocks are rising, bonds are falling, as the U.S. shutdown has also been averted. This is Bloomberg.
was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
European stocks and U.S. futures gain after Congress narrowly averts a shutdown, keeping the government running until mid-November. The UK Chancellor tells Bloomberg the government does not have any headroom for tax cuts, setting up a potential standoff with some senior colleagues. Plus, our exclusive interview this hour with the JP Morgan EMEA Chief Executive Viswas Raghavan. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, this week sees the inaugural JP Morgan's Techstars Leadership Forum in London, which showcases the talent of the future. It comes ahead of the UK's much-anticipated AI Safety Summit early next month. Now, with us now is Vis Raghavan. He's the EMEA Chief Executive Officer at JP Morgan. Vis, as always, thank you so much for giving us a little bit of your busy schedule. Now, you're hosting this tech conference in London today. Given the current deal-making volumes, which are at a decade low, what do you see specifically for tech M&A or tech IPOs?
Morning, Francine. I mean, look, I think what I would call the current environment, as you're seeing some green shoots. You saw the Microsoft Activision deal, is kind of seems to be back on track. We advised VMware on the on the Broadcom transaction, the ARM IPO, Instacart IPO. I mean, really, you are beginning to see the reemergence of a curated set of technology offerings. So, but there are some real drivers at play here too. So if you look at the private equity, venture capital universe, they are sitting on some $2 trillion of firepower, which they are incentivized to deploy. When you look at the secondary pipeline, there's close to about $110 billion of secondary paper. So this is paper where the IPO has already happened a few years ago. That is prime for for it re-entering the market, and that could be secondary placements. It could go down the M&A route. So there is even away from a real kind of a valuation, buyer seller kind of slow meeting of minds. There are some fundamental liquidity drivers that it augurs well for tech in general.
Viz, we've always talked about London as a financial center. What are the longer-term implications, though, of a company like ARM deciding to list it in New York?
I mean, I wouldn't infer too much from just one IPO. I mean, every company looks to list in the marketplace that, where its peers are, where it's going to get the most, optimum valuation, where there's going to be secondary market liquidity, research following. There are a whole bunch of factors that kind of drive the choice of a listing venue. So I think, it's a bit kind of, just to kind of infer from one IPO and draw kind of broader conclusions is probably, not entirely correct. But what London has done in terms of the Edinburgh reforms, in terms of increasing its attractiveness, will undoubtedly help. But really, I think there are broader drivers that go into a choice of a listing venue, and there's the secondary marketplace also being kind of a key driver. So London, I think the reforms in place should make it more attractive. And I think the broader desire of the overall market being attractive is also a key kind of component. And I think London is kind of slowly making all the kind of the right moves.
And overall, Viz, what are the main trends that you're seeing in ECM this year?
I mean, I would say, I think clearly the return of the IPO, that return is very curated. Especially in tech and life sciences and healthcare, the thing around growth with earnings predictability, and so it is very selective. It's a flight to quality, but if those metrics are met, there's a very high probability that transactions actually get done. Away from that, I think convertible bonds are very fashionable with the rising yield environment, volatility levels and realized vols being kind of quite attractive. The temptation on the part of kind of corporates to issue equity at a premium at a better valuation while kind of lowering their cost of financing, will mean converts are here to stay for quite some time. And then finally, it is the whole kind of the secondary sell downs, which will likely keep coming. So you'll see an element of block trades and kind of underwritten transactions. But this is going to be. It's not going to be a deluge. It's going to be very curated. It's going to be very kind of deliberate, and you're going to see this kind of quality-driven pipeline kind of slowly materialize.
So where are you seeing most business in your region? Is it definitely the Middle East, and what does it mean for hiring?
I mean, look, I think we are seeing a pickup in activity across every geography. Literally, I would say in the last quarter or maybe 2 quarters, there's been a pickup in RFPs, in bake-offs for IPOs, in sponsor bake-offs for transactions that they want to bring to the market. So I would say I wouldn't single out any particular geography, but I would say pretty much every country you're seeing this selective, curated kind of set of offerings coming to the market. You raised a very good point in the Middle East. I think the Middle East, it is the moment of the Middle East. There are kind of real kind of forces at play. All the geopolitical tensions we've seen have seen kind of liquidity migrate to the Middle East. You are seeing a real kind of swagger as countries like Saudi Arabia, UAE, Qatar, all are kind of pretty well positioned, both from attracting money managers to hedge funds to also, their own domestic economies kind of becoming mainstream. So I think this is a golden era for Middle Eastern companies and in general the Middle East in attracting both attention as well as inward investment. So I think that is really here to stay.
There's quite a lot going on with the U.S. elections. Of course, still the raging war in Ukraine. There's China uncertainty. There's fresh questions about raising rates. Do you look at the world economy and markets and think there's going to be another period of instability?
I think, look, the geopolitical instability is not going to go away anytime soon. We talk about a high rate environment, but it's almost kind of the negative yield or zero yield environment we've seen in the last several years. I think that is more of an anomaly. And if you look back, going back to our tech forum, and if you look at the $1 trillion market cap, mega tech companies, when they started, every one of them actually started and blossomed in a higher yield environment than what we have seen recently. So I do not subscribe to the view that having a healthy yield environment is necessarily bad, because it also leads to prudent capital structures and a degree of responsibility than the era of free money or cheap money that we've just kind of come from. So I do think that the market will adjust, and the cost of capital model will kind of adjust to a higher yield environment, and life goes on, and you'll see kind of companies thrive within a higher kind of yield curve.
What does it mean for JP Morgan? You have quite a lot of course, your rivals going through changes or restructuring, be it Citi, Goldman Sachs. There's also talk about Barclays, and certainly Morgan Stanley will have a new chief executive. Is that a growing opportunity for JP Morgan because of stability?
Yeah, I mean, I don't want to comment on any of our competitors, but when you look at the investment banking fee pool, Francine, I mean, the fee pool is around $80 billion or so every year. I mean, this year is quite anemic. It's going to be somewhere around $65 billion of banking fees. So you're really looking at a pool that is kind of flatlining. And against that backdrop, the way you grow is clearly to grow market share. And I think that's probably the only game in town. And to grow that market share, you really, it is... our model lends itself well, the whole kind of scale, completeness, being diversified and being global is really key. And I think, all our teams, and when you look about, our investments and investments in people, in technology particularly, when you look at the whole drive into kind of AI and the like, you really, need to lean in on each of these kind of growth kind of drivers to gain that market share and get that incremental alpha. So sadly, the fee pool itself is going to flatline, and it's going to kind of really come from asserting your share of the marketplace.
Viz, with Deutsche Bank acquiring Numis, is that a challenge, or does it change actually your prospects for corporate broking business in the city?
I can't comment on that because I don't think the transaction has closed yet. But when you look at the corporate broking model in the UK, and we ourselves, we created this JV with Cazenove nearly, over 15 years ago. And that's been an incredible success. The way we integrated it, the way the Cazenove teams are an integral part of the UK team, that's been an absolute kind of the backbone of our UK investment banking model. And we are a broker to nearly a third of the FTSE 100 and a third of the FTSE mid 250, the largest corporate broker in the UK. So I would say that model has been incredibly successful. And so it depends on how the Numis acquisition goes. But it really takes time to get these acquisitions integrated and primed for success. The other point I would make is, even within broking, the use of technology, the use of AI and the whole kind of digitalization of the whole kind of broking offering is going to be a massive differentiator. Just from everything from shareholder activity to peer sectoral behavior. To kind of valuations and comps. I think that there is plenty of scope for technology to really take broking to the next level.
And Viz, we're also, of course, in the UK party conference season. Have you spent much time with Labour or with Keir Starmer? What do you make of them? And does it change anything for JP Morgan if they were to be in power?
Look, elections it's about a year away. Hopefully. But, yes, I have met Keir. He actually he was at an event at Davos last year where he met many of the bank CEOs, and we had a round table. I met him recently at a soccer game. And look, I mean, in all our interactions with them, we work closely with both parties. And in our interactions with Labour, they seem exceptionally business friendly, and I think they understand the importance of the City of London to the broader UK economy. So we partner very well with whoever is in government. But you know, elections are some time away, and these things, as you know, are fickle and pretty unpredictable. So may the best party win.
Fiz, thank you so much, as always, for your time. Good luck with the rest of the conference. Fiz was Raghavan there, the EMEA Chief Executive Officer at JP Morgan. Now, later today, we'll also be speaking exclusively to the JP Morgan Chief Executive, Jamie Dimon. Don't miss that conversation, 3 p.m. London time with Emily Chang. Now, another exclusive with the managing partner of Sequoia Capital, Rolf Botha. That's a little bit later today as well. Coming up, the Eni Chief Executive says the new natural gas found in Indonesia will power up a new production hub in the region. So we'll bring you more of our conversation with Claudio Descalzi from the ADIPEC Energy Summit. That's next, and this is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Like, please, like, really actually tune in. I desperately need an audience.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
The conversations that matter, the insights you need. This is the Pulse. I'm Francine Lacqua here in London. Now, the Italian energy giant Eni has discovered natural gas in Indonesia in a block close to existing facilities. The chief executive, Claudio Descalzi, says a new resource would allow for a new production hub in the region, while he spoke to Bloomberg's Youssef Gamaeldin at the ADIPEC Energy Summit in Abu Dhabi.
In Indonesia, yes, I think that it's a big hit. We made a big discovery.
How big was the discovery?
The discovery we're announcing, this discovery is the well discovered 5 TCF plus, so in the range of 150 billion cubic meters, plus 400 million of condensate. Is in a good area, is close to our facilities, is close to other structures that we discovered in the past for additional 5 TCF. Overall, we have about a 10 TCF that allow us to open up and build a new hub. We have already John Creek, that is a big one, a new hub in the area. We are in Kutain Basin, East Kalimantan, very close to Bontang, the LNG plant, and very close to the good market, China, India, Vietnam, South Korea. So it's really a huge discovery that we made few days ago, we can say.
Yeah. I mean, you're clearly making quite a few breakthroughs, so that leads to the other question around whether there's enough upside to potentially justify a revision of the 3.5 billion euro buyback guidance. What's your feeling at the moment?
I think that, the situation from a balance sheet point of view is good. I cannot talk about the third quarter because we have to announce in a few weeks. But as for the first quarter, second quarter, the trend of prices and also the trend of refining margin are very good and justify the buyback. Now we are still at 2.2, clearly, not 3.5. That is the maximum range. Yeah. And that depends on the free cash, depend on the cash flow from operations. As you know, we have a dividend policies, dividend buyback that is linked to the cash flow from operations. So we have each quarter we have to control where we are and then apply our policy.
Well, that was the Chief Executive Officer of Eni on the company's natural gas discovery in Indonesia. Now, the Halliburton Chief Executive Officer, Jeff Miller, says he sees tightness in the oil market continuing amid rising demand. He also spoke to Youssef, again from ADIPEC.
Oil and gas probably is tight, and I think that, that's growing demand, and we see growing demand. Expect that continues. As far as, over tightening, I think the price of oil is going to be, a function of supply and demand. And so I think that, what we're seeing realistically is that it's difficult to produce oil and gas. And I think that we're remembering that or realizing how difficult it is to produce oil and gas, particularly as North America, wrestles with where their production is going to land. And meanwhile, we see lots of activity around the world.
Are we going to see triple-digit oil prices soon?
I always get that question wrong, so I'll just stick with what I'm seeing, which is if we look around the world, there's a lot of support for oil and gas, and particularly oil price. And below 70 never made sense to me, just given what's required to produce oil and gas. And I think, we'll continue to see tightening.
How much of a pushback are you getting from clients? Or another pushback, let's call it, what's the debate like with clients around raising service fees for next year?
Look, I think that service quality and efficiency underpin everything that we do. And so we really always start our conversations around how efficient, how effective are we? I think beyond that, there's a recognition that equipment is tight around the world. And look, we're focused on returns and returning cash to shareholders the same as our customers are. And so I think we've got a very different dynamic in the oil field today than we've probably ever had in terms of discipline, both on capital investment by our clients and by us, and also generating returns over the long term. And I think we're at a place where we can do all of that. And I think our customers understand that returns are what are required in order to invest in research and development and new technology.
Halliburton Chief Executive there, Jeff Miller. Coming up, the Treasury sell-off deepens. We discuss the drivers as well as the equity picture after the U.S. averts a government shutdown. That's next, and this is Bloomberg.
race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think they're much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress, and somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
Welcome back. Now let's take a look at the markets with Bloomberg's Valerie Teitel. So, Valerie, a lot going on when you look at treasuries, but also equities. Will the rally in equities last, given how treasury yields are actually behaving? The million-dollar question.
Yeah, good question, Francine. I'm one surprised to see how resilient the equity market is in the face of these higher treasury yields this morning. S&P futures and NASDAQ futures both solidly in the green on this first day of the fourth quarter. This is all happening amid the backdrop of rising treasury yields. Let me show you how the curve is behaving. We are nearly 5 basis points higher across the entire treasury curve. Remember, Francine, last week's narrative was very much that these higher treasury yields were really denting risk sentiment, really denting this appetite when it came to futures. It's posing a few questions out there to the market. We're now thinking about the supply and demand dynamic when it comes to this treasury market, that maybe the first big loser of this higher for longer mantra is actually the U.S. government. 30% of treasuries need to be refinanced in the next 16 months. Will these yield levels tempt foreign buyers back in, or do they need something juicier? And on that note, we do hear from some Fed speakers later today. We hear from the man himself. Jerome Powell will be speaking at 4 p.m. UK time alongside Patrick Harker, the Federal Reserve Bank president of Philadelphia. There will be Q&A from the audience at this meeting, Francine. Will he be asked about the recent rise in treasury yields, and will he mention any concerns he has with the fact that these yields in the long end have risen so rapidly in the month of September?
So, Val, what are the other ramifications of higher treasury yields?
Oh, the obvious one is Japan, especially when it comes to dollar yen. We saw it happen overnight that the rise higher in treasury yields forced JGB yields higher, and the Bank of Japan to step in again with more bond purchases, leading to a weaker yen on the day. We actually hit the lowest level for the yen this year, touching 149.80 nearly in the overnight session. Many traders have the big figure 150 on their mind for what could potentially spur the Ministry of Finance to intervene in this FX market.
Val, thank you so much. Bloomberg's Valerie Teitel there with the very latest, of course, on not only Japanese yen, but treasuries. Up next, Bloomberg Brief with Danny Berger in London, Manus Crane in New York, and this is Bloomberg.
news.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg.
Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Crisis averted. Kevin McCarthy secures a last-minute bipartisan deal to keep the government open, but triggers a mutiny to depose him as House Speaker. The Bank of Japan intervenes again to curb decade-high yields. Yen hits a new one-year low. And Jerome Powell and Christine Lagarde both speak this week as investors brace for a deluge of data with jobs jolts in focus. A very good morning to you. So last week, have you recovered from your PTSD in the bond market? It was quite literally a hurricane of revaluation on inflation and higher for longer. This morning, we start with the shutdown that has been averted. And so we're back to basics. What will Powell say to the market today? Yields march higher and the shorts are mounting in this market. You're the biggest quarterly loss since 2009. We're now down to a 1 in 3 chance of a hike in November. What will Powell say to reset the tone? In terms of dollar-yen, this is where you really want to focus. The Bank of Japan intervenes to stymie that rise in yields. You can see it at the bottom of your screen. The last time we saw this kind of intervention was last week. We're at a decade high in JGBs. This is the market testing the JGBs, testing dollar-yen. It really, the more and more that they go, the Ministry of Finance, to try and take out 150. Does it expedite a faster reversal from yield curve control is what we can ask Kit Jukes a little bit later on today. The finance minister reiterates he is watching the currency closely. And I just thought for a little bit of a frisson, a little bit of a change, Monday morning, why not have a little bit of Bitcoin? You've got 6 weeks of inflows into this market. The speculation is that the SEC will approve BlackRock's Bitcoin ETF. By the way, last quarter you lost 11% on Bitcoin, and there was a huge withdrawal from that market. $500 million came out in the last 9 weeks. Bit of Bitcoin, Danny, good morning.
Good morning, Manis. I think today's going to be a good day because I can't remember the last time you did Bitcoin. That's a treat. I like that. Getting a little bit risky today. Why not? Look, I've got some of the rest of the risk markets here. I've got equities. I think equities are going to be really interesting this October. After a very bad September, after the worst quarter in a year, can they rebound or will that bearish momentum continue? At least for Europe, it is. European equities mostly unchanged, but ever so slightly into the red. But we are on the upside for S&P and NASDAQ futures, where we may be just all too bared up about a government shutdown. Does the relief of that, the kicking the can down the road, does it allow us to rally, and especially in the NASDAQ? But you got to imagine there's a lot of threats, especially as yields pump higher. And Manis, to this point, I want to talk about today's big take, and I big take go on the terminal. It's excellent. It's from the Bloomberg economics team, who say that every other recession over the past 4 decades, everyone was calling for a soft landing heading into it. So their base case is a recession, writing a soft landing remains possible. Is it the most likely outcome, though, with the U.S. confronting the combined impact of Fed, strikes, student loan repayments, oil prices, and a slowdown? Manis, they think not.
Well, I mean, no landing, hard landing, quasi-hard landing. Either way, if you then take that statement, so no soft landing, take your Larry Fink statement that you're now looking at structurally embedded inflation that he hasn't seen for decades. I put it back to you and I say the environment then goes back to the narrative of stagflation. If it's going to be harder than they all think, inflation's going to be higher, and rates are going to be higher for longer. Does that really give you, as Lance Bernstein said last week, 2.5% on bond yields or not? Stagflation, again, will be a key part of our discussion. But Danny, let's reset. The U.S. narrowly averted, as you said, that disruptive and costly shutdown as Congress passed a compromise piece of legislation to keep the government running at least until November the 17th. Hours later, President Joe Biden urged House Speaker Kevin McCarthy to follow up quickly with support for Ukraine.
I fully expect the Speaker to keep his commitment to secure the passage and support needed to help Ukraine as they defend themselves against aggression and brutality.
Joining us now is Kathy Ackley from Bloomberg Government. Kate, good to see you this morning. So we're going to be having the same last-minute theatrics in November. This is just extend and pretend for 40-odd days, isn't it?
Right. This was just, like you said, kicking the can down the road till mid-November, where we're going to have this fight again. But in reality, the fight begins today. You know, Congress had sort of a whirlwind weekend. It could have been a much longer weekend, but they averted the shutdown on Saturday night with the Senate passage of the continuing resolution to keep the government funded until November 17th. So now there's going to be a challenge, it looks like, to House Speaker Kevin McCarthy's position. He's got, conservatives in his conference who want to oust him, led by Florida Republican Congressman Matt Gaetz. So that is something, that's how we're going to kind of start the week off here in Washington. And, you know, there are personalities, involved here. It's a personality fight, but it's also a fight over funding for Ukraine and just a whole number of other things.
Kathy, to that point, we have some sound from House Speaker Kevin McCarthy. He spoke to CBS Face the Nation over the weekend. Let's take a listen to that.
He's more interested in securing TV interviews than doing something. He wanted to push us into a shutdown, even threatening his own district with all the military people there who would not be paid, only because he wants to take this motion. So be it. Bring it on. Let's get over with it, and let's start governing.
So he's speaking about Gaetz there. Kate, if McCarthy goes, what does a likely replacement look like?
Well, first of all, either way, whatever is going to happen is going to have to look like what it looked like the House bill on Saturday. And it's going to have to be bipartisan. It's going to require Democrats. So if Congressman Gaetz is going to be successful in ousting McCarthy, he's going to need Democrats to help him do that. If McCarthy is going to stay on, he's going to need Democrats to help, vote for him or vote present or, somehow make it so that he's able to stay. So that's the first step. Something is going to be sort of in a bipartisan fashion. Who might replace him? That's not something that a lot of people are talking about because, there've been discussions that somebody in his current leadership, Whip Tom Emmer, who's a congressman from Minnesota, could be Emmer has said, I don't want the job. So that's another problem, is you got to find somebody who wants the job. Is there going to be some sort of consensus pick that Democrats and Republicans coalesce around? That's a tall order, and we'll see what happens.
It certainly is, Kate. Thank you very much for joining us for Waking Up Early. Kate Ackley of Bloomberg Government, thank you so much. And tune in later to our interview with Congressman Matt Gaetz on balance of power. That will be 5 p.m. Eastern. So what does all of this mean for markets? Joining us now is Kit Jukes, head of FX strategy at SocGen. Kit, I know you were writing before that should we get this shutdown, it would start the downtrend of the dollar. So is this dollar downtrend avoided then?
It makes it harder for it to happen right now. I think, look, you've got lots of things happening at the same time. We've had 2 really bad months for risk sentiment that's helped the dollar. We've had weak equity markets have helped. We've had a sort of a spate of continuously weak data in both Asia and Europe that have helped the dollar. And you've seen as a result of that, the positioning has sort of taken the dollar higher as people have got out of euro longs and then into, I think, a big, broad consensus long dollar position. So at the end of last week, part of me thinking, well, okay, what does that give for this week? But it sort of just throws us back to the biggest driver of all, which is this huge rise in Treasury yields as the vigilantes take over, because the one thing that's not going to stop is Treasury issuance. We're going to have to find the clearing price for all these bonds and notes. And if the next place we go is 460 on 475 on a 10-year note, then the dollar's going up. And I think the vigilantes in charge. And I'm looking at it this morning thinking, okay, we popped up to a new high because the shutdown was postponed. But we're still where we were. Really, something has to happen to make more people want to buy more bonds. And if the Chinese can't buy any because they're too busy doing something else, and the Japanese are selling them because they're doing something to help their currency, that'll all just make it harder.
Kit, good morning to you. The voice of doom there on a Monday morning. 475 on the 10-year notes. The Japanese aren't buying, and the Chinese are reluctant owners of treasuries, in actual fact, divestors. Okay, take me to 475. What does that do to risk? Because this market has not quite grasped. Last week, there was a hurricane went through the bond market. But if we're going to 475, Kit, what happens to overall risk at that kind of level? How soon could we get there?
I think it depends how fast it goes. I mean, we've had these yields and higher yields lots of times in the past. I don't think it necessarily does. You've got to remember, the overall risk sentiment is possibly the most resilient bit potentially after 2 such bad months. I've never been able to forecast equities, never understood them, but I wouldn't necessarily think they go on getting sold off. But let's put it this way: I think there's a better chance that risk sentiment stabilizes enough for emerging market currencies to get a little bit of a bid than we get the kind of good enough risk sentiment to make you think euro-dollar's going back up.
Kit, if you were excellent at forecasting equities, I think you'd need a different job, right? So I think that's okay. I think it's fine we stick to FX.
It's the only market I haven't done. Let's put it that way. There's a reason I don't do it.
Okay, fair enough. Okay, so you talked about the spending of the government. That's not going away anytime soon. What about the spending of the consumer? Could that be the thing that cracks and brings yields lower?
Well, yeah, eventually it will, right? So this is, so there is a degree to which what's been driving the U.S. economy is there was so much fiscal largesse, put so much money in so many bank accounts, and it still hasn't run out. And there's a labor market that's so tight that keeps that going because it keeps wages up and keeps the whole system going. There's a sense that, a landing is inevitable because this all does come to an end. And the politics just risks a harder landing than otherwise. But the landing takes time. I know we've got a forecast of a recession in the middle of next year. Just all along it seemed like people either said there's never going to be one or it's got to be tomorrow. And so I think we can crawl on for a bit. But the question is whether you turn the data around fast enough to really sort of move it. Because if you get a slightly softer numbers, you're not changing the story very much.
And part of that narrative for you is that you're going to see more rate cuts coming through next year, and that really gives full steam to the dollar's demise. I want to put this to you from Martin Malone, who was with Danny and I last week, and he talks about the Volcker era. 1982 was successful for Volcker. He quashed inflation, but they needed an inflation, which was worse than the 1930s depression. Note, inflation reaccelerated to 5% in 1984 and 6% in 1990. That is the single biggest risk here, Kit, isn't it? That there is some kind of an reacceleration into 2024. fall. Do you see that as a real risk and an underpriced risk?
Yes, it's a risk in the sense that, that it could happen. That I've been surprised that so many bits of the labor market have bargaining pressure. That there's so many things that are that seeing inflation try to come back. I think on balance, what you'd think is you'll get you'll get some mini cycles higher inflation, and then we'll get it back under control. I still think the global economy's changed shape enough that what we mostly consumer services and the additional cost of producing them is low enough that we're not going to go back, certainly to an echo of the 70s, which is what those sort of 80s recession cycles were. But most of all our experience of inflation is based on one period in history.
Yeah.
That's it. So we write books and pretend we get PhDs and we have one relevant period to go with.
You are just putting people out of business left and right. Hold those thoughts. We're going to get back to you. We have a lot more to cover. That's SocGen's Kit Chooks, who's going to stick around with us. All right, let's get to some of the stories that we are tracking on the terminal this morning. California Governor Gavin Newsom, will appoint LaFonza Butler to fill the remainder of Dianne Feinstein's term, making her the only black woman in the U.S. Senate and just the third in its history.
And of course, we've got China's manufacturing its activity returned to expansion in September. For the first time in 6 months, a sign that stimulus may be taking root. Of course, China's closed for Golden Week this week. Danny.
And then at the same time, the Bank of Japan announced an extra bond buying plan for this week following an unscheduled operation it conducted on Friday. Now, coming up, we're going to discuss just that, the yen, the BOJ, with Kit Chooks of SocGen. He's sticking around with us. Also, coming up later this hour, we're live from the ADIPEC Energy Conference in Abu Dhabi with S&P Global Vice Chair Dan Yergin. And then later today, Bloomberg's Emily Chang sits down with JP Morgan CEO Jamie Dimon for an exclusive interview. That's 10 a.m. New York time, 3 p.m. in London. This is Bloomberg.
Obviously, we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that because, we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women. Like, what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
The boundaries of the entertainment world are blurry, and they're all scrambling for the same thing, screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business, converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at BloombergLive.com/screentime.
This is Bloomberg Brief. I'm Manus Cranny in New York, Danny Berger in London. Danny, there's a stairway to heaven. It was written a few years ago. Well, there's a stairway to 150. Have a look at dollar yen. We've got a conundrum which is trying to battle those rising yields on the 10-year, which is the objective of the Bank of Japan, 0.775, last seen in 2013. Here we are almost kissing the 150. Can they have both? Can they have their cake and eat it? That's the question that goes through my mind, which is defend the yields and not have a weaker yen. Kit Jukes can answer that since he is FIC specialist of the Monday trade. Come on, you have doom and gloom in the A block. Let's go for what's going to happen here. How hard does the Bank of Japan defend this line in the sand, Kit? Good morning.
Good morning. I don't know how hard they defend it, but my mother told me I couldn't have my cake and eat it enough times that I got the message. You can't have your cake and eat it. So if you're going to try to keep JGB yields down, dollar yen will go through 150. And if you're trying to keep dollar yen can go through 150 and keeping yields down, you have to spend an absolute something amount of money on intervention. And is it credible? Because in the end, if your intervention isn't credible, what do you achieve? So I think the Japanese are in a terrible corner. They've got themselves in a position where it looks like they're going to make policy changes in December, and that's only 2 months away. So the chances of us not going through 150 on dollar yen seem to be quite high. What they do with the JGB market, yes, a bit more intervention of one kind or another, but it makes no sense.
Well, I mean, that is the question that comes to my mind. Why would they continue to do that? Why would they continue to buy bonds if they know it's just going to equate to a weak yen?
Because they have a target for yields and a desire not to see the yen weaken.
How do they get out of this corner then? They painted themselves in.
They try to have their cake and eat it like every 13-year-old boy does until his mother tells him, you can't do it anymore.
So what gives here? I mean, there's two massive dams at play here. One is 150, and one is, let's call it 0.80 in the bond market. We had somebody with us last week who said they see multi-year high in the dollar, 200 to the yen against the dollar. If we break 150, we're just throwing it out there for Martin Malone, really. But if you do break 150, how hard will the FX boys and girls push it?
They'll push it. I mean, I think, in a line, in a sense, 150 is just a number. 150 is followed by 155, followed by 160. I'd be surprised if you get as far as 160, something will break. But if the Chinese let the yuan go, it'll make it harder. The yen is very cheap. Actually, the cheapness of the yen, I mean, you had a Tankan this morning that on some measures was back to kind of place it was in the early 90s. So this is going to do something. The yen is cheap. And apart from everybody booking their holidays to go to Japan when cherry blossom turns up again next May, the currency is competitive here, and that will matter. But I think that I don't think you get a big speculative attack because you're at this extreme level. I just don't think you can turn it round or defend artificial levels unless you get your policy ideas lined up. And if the policy idea is it's too soon to end low yields, intervention, the things we've got, then that means you have to let the currency weaken further.
Can I just say I was one of those people this past May. I did go see the cherry blossoms.
Congratulations.
So I've done my part. I washed my hands of it.
Even cheaper next year.
Okay, good to know. That's a good call. I'll book my trip now. Kit, the data coming out this morning from the BOJ, from the Tenkan, that Japanese companies see 2.5% year-over-year inflation in 1 year. Is it too soon? Is it too soon to abandon negative rates if that's what we're starting to see come out of companies?
I mean, it depends how conservative expectations can move around faster than people who. I mean, the Japanese, we have to be sympathetic to the fact that this is a multi-decade deflationary hole that was born in the 1980s. So, premature exit from that catastrophe, it would be a really big historic mistake. But I wouldn't wait till December.
Okay, there you go. That's the call from Kit Jukes. Don't wait till December to pull the cord on YCC. Sup, Jens. Kit Jukes with his calls this morning. A quick check on markets for you. There was a hurricane pass through the bond markets. Kit Jukes says the vigilantes are still in charge. 475 is eminently potential on 10-year government bond yields. Yields are rising across the world from Germany, the UK, where there's no room for tax cuts from Jeremy Hunt. More on that in a moment. 449. Good morning from New York and the bond market.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
The markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
This is Bloomberg Brief. I'm Danny Berger in London alongside Manus Cranny in New York. The United Auto Workers and Detroit's Big Three automakers are still locked in negotiations over a new contract, including pensions and pay rises. The union is expanding its strike against GM and Ford to more assembly plants, but is sparing Stellantis from additional walkouts. Ford CEO Jim Farley is accusing the UAW of holding talks hostage over issues not governed by their contract. So, Manus, the strikes continue on.
Yeah, and you just think they're grappling with this transition to electric vehicles, and at the same time, we're going to get Tesla. They're going to tell us today how many they delivered in the quarter. And I think it's interesting, if you look back at the start of the year, Danny, what was it Elon promised us? 2 million cars. That's what was promised at the start of 2023. And of course, he reverted to that lower target of 1.8 million cars in the middle of the summer. So what are we looking for, Danny, in terms of the numbers for the third quarter?
So third quarter, the expectation, Manus, I've got this to the single digit, 456,722 cars. I realize no one's going to remember that number I just sent out to you, but basically it's lower than last quarter. This would be the first decline since early 2022 in deliveries at the time that they're cutting prices, Manus.
Yeah, look, by the way, I listen to every number that you throw across the pond at me. By the way, if you're Tesla, I mean, they are the benefits of the Inflation Reduction Act. You can get your discount on your EV there. Your federal tax credit, $7,500. Okay, a little bit more on the energy front, but this time from the petro side. We got Dan Yergin, S&P Global Vice Chairman, live from ADIPEC in Abu Dhabi on Bloomberg.
A lot of the focus on the breakthroughs were because a lot of these research labs, the OpenAIs, Anthropics of the world, DeepMinds, had this focus on AGI. artificial general intelligence. Can you build an AI that can do anything?
Yes.
And it turns out maybe you can. So GPT,
making a machine that's in our own image, in a sense. That's what AGI sounds like.
More than that, it's a general intelligence. So it's the kid that made you look bad at school because he was good at everything. You know, the top performer.
Right.
Like GPT-4 now can pass the bar exam, the medical licensing exam, the GRE. It's probably going to Stanford, you know,
Right,
next
absolutely.
fall. But then our take was, that's great. You can have these amazing giant general models. What will be better is to mimic humanity, where our companies are not one generalist doing everything. What if we made it so you could bring your own data to the models and have lots of specialists working together and have those models working for you that you own?
Right.
These models, like really talented graduates that occasionally went a bit weird, it's called hallucinations or other things, but that's because we feed them bad data. So we were like, what if you had open data, open models, and allowed it to be customized and specialized? So again, like a talented graduate, and they can learn very quickly from a few examples. So they have this base of generalized knowledge. They've been through kindergarten, high school, and university, but they're not specialized yet. But you can train them yourself, or you can just show them some examples, and they learn very quickly.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Welcome back to Bloomberg Brief. I'm Menace Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. Crisis averted. Kevin McCarthy secures a last-minute bipartisan deal to keep the government open, but triggers a mutiny to depose him as House Speaker. The Bank of Japan intervenes again to curb decade-high yields. Yen hits a new one-year low. And Jerome Powell and Christine Lagarde are both due to speak this week as investors brace for a deluge of data from jobs and jolts in focus. Equity markets had a very bad month last month, a very bad quarter, the worst quarter since 2022. The direction of these next couple weeks will be crucial. Is that downward momentum going to continue, or were we too bared up on things like a shutdown? That's maybe why we're seeing some relief from S&P and NASDAQ futures, up at least 0.5% in the case of the NASDAQ. Europe, it's a different story. We're moving lower this morning. We're down about 1/3 of 1%. It's the diverging fortunes between a still strong and hopes for a soft landing American economy and Europe, where the data is weak. But Manus, I know you're about to show me some higher yields. So I look at something like the NASDAQ outperforming, and I really got to question its lasting ability if yields are going higher.
Well, yeah, I mean, we just had a conversation with Kit Jukes where he says that he thinks that the dollar ultimately will top out into next year. You're going to see rate cuts, but he also makes some pretty strong calls to challenge that sustenance that you've got in the NASDAQ this morning. If you look at yields, we're trading higher, and we are trading higher globally this morning. So it's not just U.S. yields. You've had real PTSD from last week, and Kit says you could eminently make it to 4.75% on bond yields. The vigilantes are in charge. That hurricane has not gone away. There are more spikes in yields to come, potentially up to 4.75 in the US. I put Bitcoin on the board. I just thought we'd show you a little bit of light relief. You're looking at a nice set of inflows. There was a divestment of up to $500 million in the past 9 weeks, but you had a drop of 11% in the last quarter. But there is a potential that the SEC could approve BlackRock's ETF, the Bitcoin ETF for BlackRock. So you're just seeing this sort of slight resurgence in the likes of NASDAQ, the likes of Bitcoin, because there was that battering last week. When it comes to dollar yen, you cannot have your cake and eat it. That is a view from SocGen. You can't defend JGBs, which are at the bottom of your screen, which is step in and really stymie the rise in yield, and at the same time hope that you can defend dollar yen. 150 is going to be taken out. If you continue to try and defend the yields, 150 will be taken out very soon. And it's not a question of where dollar yen will go to. It's just a question of, it's a punching bag, really, isn't it? To try and gut punch dollar yen until you see when does the Ministry of Finance actually roll over and fold. Danny.
I think Kit referred to the BOJ as a little boy who wanted to have its cake and eat it too. Look, some fighting words from Kit Jukes, who also said that waiting until December to act for the BOJ would be too long. They've got a decision in October. Will they move?
You see, I left you a bit of cake on the plate, you see? There you go. But let's talk about crude prices because they're tracking towards $100 a barrel. Saudi Arabia, the Saudi Arabia-led coalition, the OPEC supply cuts, the Middle East will play host to the region's largest energy conference. Let's get to ADIPEC now for the energy conference in Abu Dhabi. Yusuf Kamal El-Din is on the ground there with the S&P Global Vice Chairman, Dan Yergin. Yusuf, good morning.
Good morning, Manus. Good morning, Danny. Yes, it's been a very busy few hours. I mean, everybody's standing shoulder to shoulder, getting into the debates around the energy markets, and we want to chip away at that with Dan Yergin, who joins us here around the set. Dan, I mean, WTI at $90 a barrel, Brent at 92. We're coming off the highs of last week. Still been a monster previous quarter of a rally of 29%. When you look at the fundamentals, when you look at the technicals, is there enough muscle to keep the prices at the current levels, let alone push it sustainably into triple-digit territory?
Well, on the one hand, of course, you have a tight market, supply cuts, also inventories are low. On the other hand, it's still the overhang of the interest rates and what's going to happen to GDP growth. And that's where the tension is coming, and you can see the oil price bouncing between those two things.
I was looking through a note from Citi in the last couple of hours. Ed Morse, who you're very familiar with, he's saying oil prices are going to collapse to $70 a barrel in 2024. The surplus is going to come back, and basically you're going to have a complete turnaround in sentiment as well. Is that something you can foresee as well at this point?
I think so much depends upon economic growth, whether that happens or not. But you're going to move into a quarter where demand is going to be weaker anyway, and that's going to be weighing on the price. Whether it's going to collapse or not, you know, it's tell me what's going to happen to Chinese economic recovery.
One of the things that has been spoken about quite a bit here, both on stage and off stage, is energy policy within OPEC Plus. And Saudi Arabia has kind of taken the lead with their unilateral cuts. They've extended those to year-end to 1 million barrels per day. How worried are you that the Saudis may be over-tightening given the fragility of the global economy?
Well, I wouldn't say that I'm worried about it. I think what they've done is they want to put a floor under the price of oil, and it's been a pretty high floor. And also they wanted to bring down inventories. So, I mean, that's what they've done. You know, how long that holds for and what's going to happen next year. I mean, the big issue that's happening, people are not talking about in the oil market, is the strength of non-OPEC plus oil. The growth in the United States this year is 1 million barrels a day. Brazil, Canada. Canada's going to grow 500,000 barrels a day next year. And so it's basically is that the non-OPEC plus oil is growing faster than demand. That's the factor that goes unremarked in the discussion about oil prices.
When I look at production capacity across OPEC plus, I see that they're at levels that we haven't seen in a few years. You've seen several cycles of both higher and lower production capacity. What are the immediate implications for the market?
Well, I think that obviously for the producers, it's about revenues, and then you have the whole complication about the war that's going on, and the fact that you have a divided oil market now with Russia that's kept its production up, and so that's what the market is struggling with, and I think that's what's different. That that energy markets are not the way they were on February 23rd of 2022.
You mentioned non-OPEC oil, and I look at the United States. The strategic petroleum reserves have not been refilled. Energy is going to be arguably top of the agenda for the political contest in 2024. How high do you think it will rank in that debate?
It depends on one thing.
What's that?
Gasoline prices. And you heard Joe Biden the other day saying, I promise you I'm going to bring down gasoline prices, because, I mean, anybody running for office knows that that is a very volatile issue in American politics.
You think the Americans can persuade the Saudis to add a few more barrels in a sort of a grand bargain with Israel, maybe kind of security arrangement? Because, that seems an opportunity for the administration to take.
Right. I think that the kind of oil policy is marching its own track. However, if you get to this mega deal, all these other aspects are happening, and it's a very complicated mega deal, then clearly oil prices would be part of the discussion as well.
What is your sense is the pain threshold for gasoline prices? I mean, where What number you think it's going to be more of an issue?
I think as it gets around.
Are we there yet? We're getting close, aren't we?
Close. I think around $4 a barrel is when you start to hear about it, because Americans, they drive a lot of miles to get to work. And by the way, that affects the Democratic voters.
Okay. What about peak fossil fuel demand? The IEA has been out and about, and they're pushing their report saying that we're going to see that peak this decade. Does Dan Yergin think that's realistic? I see a smile there.
I don't. I think at this point it's still the view that I have in the new map that oil demand peaks around 2030 or the early 2030s. I mean, it was 100 million barrels a day. Now we're close to 104 million barrels a day. I think, again, it will depend upon what happens for growth in terms of the emerging markets. So somewhere there's a peak. By the way, the peak doesn't mean it's going to collapse. It means that it's going to start to flatten out on the other side.
I want to return to a couple of more things. What do you expect OPEC Plus to do this week? Do you think they're just going to, stay the course?
I think stay over. I don't see any sign that they're going to make any dramatic change.
And the other thing that stood out to me and many others is that they are trying to add the climate component to what is essentially has always been a petroleum conference, decarbonization across the energy and supply chains. How would you quantify the progress that's been made by the United Arab Emirates thus far in that direction?
Well, I think in the United Arab Emirates, I mean, it's clearly on one hand they are a growing oil producer, but on the other hand, they've made a big commitment on decarbonization. And we had a meeting yesterday with a whole industry group, and the whole theme was decarbonization. What are the technologies to do it? And I think that that's going to be a big thrust here, of course, going into COP28, because they want a COP that's going to be not words but action, and decarbonization is the theme that runs through everything.
What do you make of the apparent contradiction about the UAE being an energy producer versus them hosting COP?
Well, I think it's reality. I mean, in fact, 80% of the world's energy is hydrocarbons, and the hydrocarbon industry needs to be part of it. And every company, I mean, I was just listening to all these CEOs yesterday, they're all have putting billions of dollars into decarbonization, whether it's going to be biofuels, whether it's being carbon capture, whether it's going to be hydrogen, whether it's electrons or molecules. That's where increasing effort's going to go.
Dan, terrific to compare notes as always. That's Dan Yergin, the Vice Chairman of S&P Global and author of The Prize and the Quest, both books that are in my living room bookshelf. Danny, Anis?
Yusuf, thank you for bringing us that conversation. That is Bloomberg's Yusuf Gamal Aldin. Thanks so much. All right, coming up, we're going to speak to Elliot Hentov of State Street Global Advisors to discuss the averted U.S. government shutdown. Is it just averted for now? Is drama still to come? All of that next on Bloomberg.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
When you go through a period when it's super easy to raise money for any purpose or no purpose, and you go into a period when it's difficult to raise money even for a good purpose, clearly many more companies are going to founder.
This is Bloomberg Brief. I'm Danny Berger in London alongside Manish Cranny in New York. Now, Congress has averted a government shutdown at least until November 17th. Joining us now to talk about it is Elliot Hentoff, head of macro policy research at State Street Global Advisors. Elliot, great to have you on the program. Great to have you on set. Look, one of the possible consequences of this shutdown is that House Speaker Kevin McCarthy is going to be challenged. Usually investors don't really care about who's the House Speaker, but should they this time if it means he might be replaced by someone on the more far right?
The worry is less about the replacement and about process. I know this is boring parliamentary procedure, but in this case, theoretically, if he does get removed, no other business in Congress can take place until a new speaker takes hold. Given that there's no agreement on an alternative, that process could take a long time, which is why my hunch is that the Democrats would probably keep him in place, and that would probably be enough to sustain his speakership. Given they had the debt ceiling deal back in June, I presume that was always kind of part of the plan B, so to speak, and therefore McCarthy has surprised all of us with the confidence to kind of challenge the fringe of his party.
But that fringe of the party are going to keep going. They're going to keep challenging McCarthy, one would think. Good morning to you, Elliot. Good to see you. Here's the issue. We're in this extend and pretend zone. We got 40-odd days to run. We're going to be back at it again. And it's going to be Ukraine versus border security is going to be top of that agenda. What is it that the market is not getting about the situation in Congress at the moment? The fiscal situation is something that you highlight.
Well, I think the market is getting what's going on in Congress. Namely, we have a very loose fiscal position, we have a very tight monetary position, and therefore the currency strengthens, and that's exactly what we've seen. What I think the question mark is, how long is that sustainable? This is a growth period. The U.S. economy is actually doing fairly well, and we have a deficit running at close to 8%. That's obviously not sustainable. So the question is, when do you get the fiscal drag kicking in? And once that kicks in, it's probably going to happen at a similar time as yields peak, and therefore you also get the inflection point for the dollar on the FX market too. But when is the big question mark?
What happens when we do get there, though, and we have that inflection point at a time where we've already been spending so much? It seems like we're almost out of ammo to really help the U.S. economy if we get to that inflection point. Is that fair?
Clearly, we're out of ammo in terms of can you get more fiscal expansion?
Yeah.
I do not think so. You already have 10 years barreling towards the 5%. At some point, financial conditions will get too tight for the economy to keep growing. So, yes, we must be nearing that point. It's a little bit like a rubber band. We're pulling and stretching it. We all know you cannot stretch it indefinitely. One thing's clear. After the election at the latest, you're going to get a serious fiscal consolidation in the U.S., and that's going to obviously also be a headwind to growth.
Elliot, there's a chart that we use quite often, which is about the amount of interest that the government is paying on a regular basis. We're now looking at the cost of debt at $1 trillion. I like what Bank of America had to say, which is yields rising, the cost of debt servicing rising, the losses, if yields went to 5%, would be around 50% in 3 years. So we move from this U.S. exceptionalism to U.S. debasement. What would U.S. debasement look and feel like?
Yeah, so if it was an emerging market, we know what it would feel like. Foreign investors would leave, the currency would depreciate, yields would shoot up, and until they got to a level where it's attractive again. And now, with a reserve currency issue like the dollar, that's a very different dynamic. Here, what happens is you do gradually get a rise in yields until the point where financial conditions tighten and growth starts to slow down. And so the U.S. economy eventually suffers from the costs of servicing the debt burden, and basically trend growth starts to decline. And that frankly is a little bit of a worry going into the future, unless some of the fiscal spending we've seen has gone into productive investment. Is it really all going into manufacturing and semiconductors and industrial chips and high tech? Well, then maybe we actually will be surprised, and the productive capacity matters. Okay. You showed that chart. That chart on its own doesn't matter. So you have to measure it relative to the revenue of government. And that chart looks scary right now because we see the steep rise.
Well, there's also this warning from Ray Dalio that, okay, you have all this issuance and someone needs to buy it. And at the same time, we have bonds coming from the Fed too. We're engaging in QT right now. Is there a point at which the Fed changes course, maybe even restarts QE, even buys bonds with this deluge of supply?
Danny, thanks. You're setting me up with that one because actually I had posted a note to clients earlier this year thinking that by the end of the summer, QT would end precisely for that reason, because the massive issuance after the debt ceiling deal and continued balance sheet runoff would make long-term yields just simply too expensive. But the problem is the communication. How does the Fed pivot on the balance sheet without signaling that the rate cycle is over? And so in many ways, they've built up this conundrum, and frankly, I do think QT will have to end fairly soon.
Okay, well, that's the US side. Let's travel across the pond for you, because today the UK Chancellor Jeremy Hunt, he caught up with the Bloomberg team. Lizzie Burden was on the ground on the sidelines of the Conservative Party conference, Elliot. So let's take a listen to how he set the agenda.
If we want faster growth and also an end to taxes ever ratcheting higher, that is possible, but there are no shortcuts. We have to spend taxpayers' money more efficiently. We need to reform the welfare state. Those are difficult decisions, but they are decisions that Rishi Sunak and I are willing to take, because the choice in British politics is between a party that does want to bring down the tax burden and the Labour Party that doesn't.
So, Elliot, the top line of that conversation really was there's no room for any tax cuts. A year ago, we were dealing with Trustonomics, Kwasi Kwarteng and Liz Truss. Here we are with a Bank of England whose hands are tied behind their back with rates at the moment. The sterling is under considerable pressure. Fiscally, when you look at the situation in the United Kingdom, how much tighter? Does the tightening come fiscally in the UK ahead of everywhere else?
I would say the policy pivot in the UK over the past 12 months has kind of front-run and released some of the pressure valves. So no, I do not think the situation in the UK is any more acute than elsewhere. The problem is, though, that because the sensitivity to bond markets is so high here, the government has to tread carefully about signaling any type of loosening of the fiscal position. So it's a delicate dance, and that's what makes the UK a little bit more sensitive vis-a-vis the markets.
Yeah, we don't want any more lettuce offs, lettuce timeline offs, whatever the phrase for that is. I think we hope we're past that period. Elliot, I'm afraid we're going to have to end it there. Thank you so much for joining us. That is Elliot Hentoff, head of macro policy research at State Street Global Advisors. Now, later today, we're going to talk again about the Congress showdown with the man himself, Congressman Matt Gaetz. That will be on Balance of Power at 5 p.m. Eastern. Coming up first, though, on this program, a look at some of the market-moving events for you to watch throughout the week. Here's a quick check on your markets as we head to break. We are getting that risk on bid, but the bad news, Treasury yields moving higher. How much of that is about supply? 4.6% on your 10-year yields. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
Welcome back to Bloomberg Brief. I'm Danny Berger in London. Manish Krani is in New York. All right, let's get you set up for your trading week. We get a deluge of data leading up to the main event, that is Jobs Day on Friday, plus a host of PMIs coming from Germany, France, Italy, and Spain. Those will hit on Wednesday. Now, on the monetary policy front, we're going to be getting more central bank decisions. They will come out of Australia and India. Are we going to see a very same tone of the hold and wait from the Fed and now the ECB? Plus, Chair Powell's roundtable discussion at 11 a.m. Eastern. Then there's President Lagarde's remarks on Wednesday. Man, this will be interesting to see if they're comfortable with where yields are or if that tightening condition means they want to talk down markets a bit.
Yeah, I mean, it looks as if the birds are still in charge of those bond markets this morning. We'll tap into the zeitgeist of where we are with tens in just a moment. There's a couple of other stocks we should be watching. Danny, just on the market, you got Microsoft. You got the CEO there, Satya Nadella. He gets set to take the stand today as part of the Justice Department's antitrust trial against Google. And then, of course, we've touched on this, haven't we? Tesla, haven't we, Danny? Record car delivery streak could come to an end in the third quarter. Analysts at Bloomberg predict 456,000. I know you've got the other numbers in front of you there. 456,000 for the period, lower than the previous of 466. But what else have we got, Danny?
Well, we're also watching crypto. I feel bad taking this from you, Manus, because you did Bitcoin today. But anyway, crypto stocks are higher. There's that crypto rally. The hope is, as you mentioned, Manus, I literally learned this from you, that there is more optimism that the SEC is going to approve a spot Bitcoin ETF from BlackRock. So that's got Bitcoin excited and the individual stocks themselves. But take it away, Manus, on the treasuries.
I just thought we'd frisk it up with a little bit of Bitcoin. Quick snapshot of what's going on in the bond market. The birds are in charge. There you go. There's nothing. The hurricane continues. The vigilantes are alive. And SocGen joined Bloomberg Brief this morning with a call of 475 on treasuries, Danny. So these bond markets are erupting higher. There's a lack of belief that we're in an extend and pretend period in the U.S. situation for shutdown.
with sensors. There's several cameras that look out at your world because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, several years from now.
So what rules would you put in place, and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, just educating them on what it could do. But I think first and foremost, the data that it collects, there needs to be an understanding, the user needs to understand the level of data that it's collecting, and then be the one who says where that data goes.
In the U.S., we see inflation cooling, we see the economy slowing.
Disinflation, it has been very consistent.
The transmission of higher rates really didn't flow through with the normal 4 to 6 quarter lag that we were expecting.
I think we're seeing the beginnings of an unraveling.
We continue to think that the Fed is at a peak. We also continue to think that the Fed is going to be cutting interest rates next year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Shutdown averted. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market pop off the back of the weekend's news. It's going absolutely nowhere. The S&P 500 almost totally unchanged. TK, a spike, and then it fades, and it fades quickly.
It fades quickly, and we're back to an 18.12 on the VIX. I'm just watching the VIX as a thermometer here, but the correlation out to equities, bonds, currencies, commodities is really, really rich. And I just want to say the tea leaf for me on a Monday morning is I see Japanese yen just creeping. It's ever so slight, folks. It's just teens weens. It's just a little bit of yen weakness. That's what I'm watching more than anything.
Just short of 150 at the moment, Tom, 149.74. Lisa, we avoid the government shutdown for now. We'll get payrolls Friday data later this week, but ultimately we're going to do this all over again in about a month, aren't we?
Yeah, I can't wait until November when we get to have this whole discussion again. We do have Citi's Andrew Hollenhorst coming up this morning and saying that he does believe that we're going to get some sort of resolution just like the one that we got yesterday, or over the weekend rather. What I find interesting is that the threat of higher rates, the threat of a lack of economic weakness on the heels of a government shutdown is what's spurring some of the concern in markets today. All of a sudden, people are taking the bond move seriously.
Hello, Q4. Should we go through the list of things?
Please.
Energy prices, rates, student loan repayments resuming, TK. Apparently this is the quarter, not last quarter, the quarter before, but this is the quarter when this consumer finally begins to crack.
Well, that's the basic theory. And then you talk to optimists, and there's a number of them out there who say, no, you saw the angst in September. I had a great conversation with Neil Dutta, I believe it was on Friday on radio with Paul. And Neil just flat out reaffirmed the resiliency of the consumer, even with all the challenges. And he made clear this is not about 4% growth, it's 2-ish.
There are some companies speaking to weakness. The team here at Bloomberg did a fantastic job over the weekend of putting this story together. Lisa CarMax, Costco, JetBlue, Dunham Restaurants, speaking to some weakness out there as well. Jane Fraser Citi talking about people with low credit scores, starting to see some weakness there too. I wouldn't say it's absent, it's there. How big is it going to be, and whether it grows through Q4, I think is the big question we've got to ask through this morning, through this week, and through the rest of this month.
Does it grow enough to reduce the inflationary pressure that's coming back up in certain areas? And I think that's one of the key questions at a time where the housing market is really dealing with a lack of supply, and where you have services prices that have really hung in there. So if you have this kind of inflationary pressure and weakness for some people, albeit real weakness, is it enough to achieve what the Fed is looking to achieve.
Tons of data, a load of Fed speak as well. Bramo's going to walk you through that in just a moment. Here's the price action at the moment. The S&P 500 was positive by about 0.6%. Then it fades. We're up now by just 0.06% and going almost absolutely nowhere. In the bond market, we're going somewhere. You know where that somewhere is at the moment. Yields higher by 6 basis points. Your 10-year 4.63. Again, the dollar showing some strength. 11 weeks of strength against euro weakness has been absolutely phenomenal, TK. That currency pair, 105.37.
In the beginning of the quarter, do we shift from a 2-year Fed analysis to a 30-year bond real economy analysis? The chart of the 30-year bond, it's just simple. It's breaking out the new highs.
It's in the 470s.
I think it's under talked about.
At least this morning, 474, yields up 4 basis points at the long end.
Yeah, and Deutsche Bank says the damage in bonds has been more severe and sustained than for equities. When is it going to actually cause something to break? 10 a.m. Very curious to see what we get from U.S. ISM manufacturing as well as prices paid, especially because we've had almost a year of contractionary readings from the ISM here. It's starting to inflect upward, and this is what I'm talking about when you have the kind of inflationary pressure in areas that have been in recession that are suddenly recovering.
I never looked at this. Pharaoh taught me to look at this. And John, it's nonlinear. 50 is the center point, and from 50 to 49 is different than from 49 to 48. Every point matters.
The line in the sand is 50, the difference between expansion and contraction. At least as we've discussed over the last several months, weakness in manufacturing, resilience in services, and the question we've asked, Mislav Matejka over at JP Morgan, I think has been good on this as well, is whether manufacturing comes up to services or services comes down to manufacturing. Now, the bearish people out there have been saying services will come down to manufacturing. What we're seeing more recently is maybe manufacturing starting to lift, which I guess is the point you're making going into this data point.
Especially given the fact that Chinese economic data seems to be on the margins rebounding just a touch. At 10 a.m., we hear from JP Morgan CEO Jamie Dimon, who's going to be speaking with Bloomberg's Emily Chang at the JP Morgan Techstars Forum in London. Curious if he reiterates what we heard from Jane Fraser last week. And today, Tom, this is just for you. The Fed Speak lineup includes 11 a.m. Fed Chair Jay Powell and Philadelphia Fed President Patrick Harker. We have 1:30 p.m. New York Fed President John Williams reprising his speech from last week that he had to miss. At 7:30 p.m., Cleveland Fed President Loretta Mester. Will any of them say anything to give the market any conviction when they basically are looking at a lot of uncertainty and data dependency?
I'm going to say 4 heavyweights today. Do you think they compare notes? Do they have like a conference call? Does their staff have a conference call beforehand?
Well, you'd have to imagine that the views of Williams are closely aligned to the views of Powell. And Williams, I think, has been outspoken on issues that Powell doesn't really want to engage in, particularly around R-star and the long-term neutral rate and all of that stuff as well. It's interesting, isn't it?
It is.
Powell won't talk about cuts, but Williams will give you why they might deliver cuts down the road.
I wonder if he feels bad about doing that and having that be the focus, or if that's actually he wants to be the front leader when it comes to having this discussion. They're kind of in a no-win situation, and I wonder how much they've lost the plot. Do people actually listen to these speeches and really parse through?
You can turn up and ask some questions today.
Okay.
You do that. Is this actually the speech from Friday that he's just going to deliver today?
No, he actually did release it. He's speaking at a different speech at 7:30 p.m. He actually did release the text of that speech.
No, I read the text of that speech.
Yeah.
I was just wondering whether he was going to turn up in person and just read it.
I think this is in New York City.
Okay,
the other one was in Long Island.
All right, good to know. Laurie Cavassini joins us now, Head of US Equity Strategy at RBC Capital Markets. Laurie, what if I have you with us on the programme to kick off this trading week? There's a line in your recent note, we aren't convinced this is the end of the current period of equity market weakness. Laurie, why is that?
Well, I think that basically what we did with the government shutdown is we took one of a number of different issues that have been weighing on market short term off the table. And we only took it off the table for, maybe a month and a half or so. We'll see how long it lasts. But I think, we always look at these kind of episodes in markets and say, where was sentiment? And I don't think sentiment got bad enough last week to serve as any kind of big springboard. So we were looking at some of the commentary that was coming out over the weekend saying, it's time to buy, we're in the clear. And so, well, this thing has just been kicked down the road. There's still a lot of other stuff we're going through. And sentiment just never got that bad. We saw concern come back last week. We didn't see fear. And if you look at the AAII survey, net bulls got down to about minus 13% on the weekly data point, but the 4-week data point, the 4-week average was about flat. You contrast that with back around the SVB period, we were at minus 20% or worse for 4 weeks in a row. So we're just not anywhere near the same kind of point where we can say, okay, it's so bad, we got to go higher from here.
Laurie, once again, small caps disappoint. I have a chart I keep of the NASDAQ 100, granted it's 7 or 8 super stocks. Maybe they're Dow stocks, but we don't want to admit it. and the Russell 2000, and it's a chart of failure. What should these companies do if they can't get value from the market? Should they go private? Should they merge? Should the zombies go away?
Well, I think there's always going to be, sort of that zombie element in the Russell 2000. I don't think they're going to, disappear anytime soon. I do think that we have to keep an eye out to see whether or not there's more M&A activity that comes up, particularly in an area, say, like the industrial space, where we often hear from small cap portfolio managers that quality of management and quality of businesses is quite high. So I think that's one thing that we can look at. I think, frankly, small caps just have a problem at this point in time after that last Fed meeting, because while I do think 2024 cuts are still on the horizon, that's still the call of our rate strategy team. I think there's starting to be some doubts about how many cuts, about when, and that was really the catalyst, I think, that small caps needed to really get going, and it seems like it's been damaged. I think we're also just in an air pocket of economic uncertainty right now, and small caps, I think, also needed to see incremental enthusiasm about the 2024 economy emerge, and instead we've gotten the return of uncertainty in here.
Lori, a couple of months ago, you came on and you expressed caution, but said you were not bearish, that you did see equities muddling through. Am I hearing that you are more bearish now after seeing where bond markets are, how high yields are, the fact that that yield cuts, that rate cuts are not being priced into the market, maybe shouldn't be priced into the market for next year?
No, I think, our head is still really where it was at the beginning of August, that we've got some short-term issues that we've got to work through. We've had a tremendous run in the market this year. I would say, though, there's definitely a camp of strategists out there, right, who are very much in the doom and gloom camp for next year. And I wouldn't put me in that camp by any stretch. I do, sort of subscribe to what you guys were alluding to as the Neil Duda view earlier of kind of the resiliency of the consumer. I just think we're not going to get a lot of information about that in the here and now. Companies seem to have planned up, and they're frankly not saying anything that's all that useful, whether you're looking at conferences or the last round of earnings reports. And I think that's a problem when you've had the year like we've had. Doubts are starting to creep in about the economy again, and we're not getting a lot of stars to navigate by at this point in time.
I think the interesting point about this moment, Laurie, is that unlike through the rest of this year, consumer discretionary is starting to crack. The equity market is starting to show some real weakness there. The story of the year has been consumer discretionary has really performed quite strongly. What do you take away from the weakness we're seeing in the equity market for discretionary recently, Laurie? Whether you see that as a buying opportunity, have we discounted enough going into Q4?
I think it depends on what part of consumer discretionary you're talking about. We talked a little bit about small cap earlier. Small cap consumer discretionary stocks, which do tend to, sort of migrate more to the lower end. They're more domestically focused. They priced in a recession last year. The big cap S&P 500 consumer discretionary stocks did not. And while valuations don't look terrible right now, they haven't been looking cheap at any point in our model over the last year and a half. So we think the risk reward there is not fantastic. And then, we talked a little bit about higher bond yields. That's really, I think, probably one of the biggest problems we're dealing with. And the problem is that it traditionally, if you look in a post-GFC world, the sectors that do most poorly when bond yields are rising are things like consumer discretionary, communication services, kind of those growthier parts of the market. So you've got a sector that didn't ever get cheap enough, economic angst is rising, and you've got this bond yield negative catalyst hitting all of, kind of hitting at precisely the wrong time.
Lori, James Dimon is going to get all the press today. He's going to do chit chat with Emily Chang in London. Great. It's all going to be, the usual big bank stuff. The BKX chart is a train wreck. Are the banks the mother of all value traps here?
It's interesting. Financials should be outperforming in a higher bond yield environment. They're not doing that right now, not to the extent that they should be anyway. And we're seeing, energy has really kind of sucked, some of the benefit that the other parts of the value trade would see. I think it depends on your time horizon. I do like financials in the S&P. We're overweight. We have said we like energy better. You are seeing a nice revisions recovery if you look at the bank space in particular, but we haven't quite crossed over into positive revision territory. Things have just been getting less negative. I do often find that when you see earnings revisions turning, but they're not quite in positive territory yet, you still have a lot of doubters in the trade, and that's often a good opportunity to come in. I think there's money to be made here long term, but I do think you have to have a stronger stomach, and there frankly may be other parts of the value trade that just don't have as much hair on them.
Hey, Laurie, thank you. Good luck for the rest of this week. Laurie Cavasini there of RBC Capital Markets. What a quarter we leave behind in Q3. 10-year yield higher by more than 70 basis points. And to your point, TK, real feeling, just eyeballing this. Look at what's happened with yields. Look at what hasn't happened with financials. Yeah. It looks like this year higher yields hurt banks, don't help them. That's been the story so far.
And it's been, you know, some people will say, well, that's not what's in the textbook, but I think we're not in a textbook time. And what's so important here, folks, looking to Q4 and your beliefs, which are going to try to help you with good conversation, is a basic idea of ambiguity. Every single narrative we talk about can cut two ways. When you overlay 30 narratives on top of each other, it becomes a toxic brew.
A toxic brew.
That's what we are.
A Bramo brew.
Elisa,
Laurie made the point that she doesn't think the weakness is over. Just to be clear, if you were waking up this morning, just tuning in, welcome, and you thought we'd get a decent pop off the back of avoiding a shutdown, equities are now negative on the session, Bramo. Equity futures just turning negative.
I thought it was amazing what Deutsche Bank's Jim Reed said. You can't have this much value destruction in bonds without there being some stress somewhere. Where is that stress going to show up?
It's going to be a big focus for us through this week.
Hey,
the mess been bad.
That's a low blow.
What about the Jets?
Showalter takes the door. End of the season.
Are we talking about the Chiefs later?
Yeah, we'll do that.
Taylor Swift and all of that good stuff.
I had to leave in the third quarter.
Looking ahead to payrolls Friday, tons of data and a little bit of Fed speak. In fact, a whole lot of Fed speak from New York. Good morning.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
All eyes turn to the U.S. job market.
The jobs report, it beckons.
It looks like companies are just holding on to workers.
What you see is what you get. We're seeing a lot of strength.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
This is exactly what the Fed is looking for.
They now believe you can get back to 2% without damaging the labor market at all.
We might get a bigger whammy than we expected.
The September Jobs Report, Friday on Bloomberg Television and Radio.
Last night, Congress passed the spending bill that's going to keep the government open. And it's good news for the American people. There shouldn't be another crisis. There's no excuse for another crisis. Consequently, I strongly urge my Republican friends in Congress not to wait. Don't waste time as you did all summer. Pass a year-long budget agreement. Honor the deal we made a few months ago. Stop the games.
The President of the United States, a stopgap funding bill that will take us to November 17th, but lacking the aid for what he ultimately wants, which is the aid for Ukraine. Much more on that story in just a moment. Your equity market on the S&P 500, totally unchanged. We're going absolutely nowhere on the S&P. You do not get that spike that you were looking for. In the bond market, yields are higher by 5 basis points, 462.48 on a 10-year currently. In foreign exchange, the dollar showing some strength, the euro some weakness. We've had 11 weeks of this. Just absolutely remarkable. The resilience of the US dollar, the weakness in the euro for more than 2 months, 105.38 on that currency pair. Jordan Rochester, Nomura, a little bit later, 102 is what he's looking for in the near term. Want to look at crude briefly? TK 91.68, up here by about 1%. Ed Morse of Citi thinks we can head back down to the 70s. Yeah. That's making some news. A bit of a splash from Citi this morning on that, going back to the 70s next year.
This is percolating around the certitude of greater demand EM and a move up in the sustaining 100 and even as higher up to 120. And Daniel Yergin, in that important conversation with Youssef this morning in Abu Dhabi, really talked about the overestimation of demand coming on, as you hear from Dr. Morse.
Here's the quote. Demand looks constrained as the pandemic recovery factors continue to ease off. They go on to say, and peak transport fuel demand looms while supply is growing in non-OPEC plus suppliers. That's ultimately the call, Tom, coming from Ed Morse and Citi this morning. Bearish crude.
Yeah, bearish crude, and of course that folds into all of our efforts here for energy independence in the United States. On a Monday morning, as we recalibrate not only for fourth quarter and for 2024, it is timely to talk of some of the themes maybe a bit removed from what we do every morning. We do this with the United States Undersecretary for State for Economic Growth, Energy and the Environment. Jose Fernandez joins us this morning. Mr. Undersecretary, thank you so much for joining Bloomberg. You know, I've really got to say that Lisa Bramwitz and John Farrell have some important and timely questions on lithium and the rest. I just need a panda update. When do we get pandas back at the Washington Zoo? You were directly involved in these negotiations where China, I guess correctly, took the pandas back to Chengdu, and all they've done to save these beautiful animals. But what's the plan for the second term of the Biden administration to place pandas appropriately in Washington?
Tom, I'm sorry to see the pandas go. They were great ambassadors. They were some of the best ambassadors sent by the PRC to the United States. So I'm sorry to see them go. But look, our relationships with China are as we've talked about several times, it's about competition when we have to compete. It's about calling them out on some of the concerns that we have in their market practices, in their human rights practices, and in their intellectual property practices. And we're going to continue doing that. Having said that, you're talking about a country that is one of our largest trading partners. So we also have to work with them as well. But I'm sorry to see the pandas go.
One of our practices, and I know you did this in inorganic chemistry at Dartmouth, is we're losing lithium to China. The fact is, front and center in our technological battle are these rare minerals. What is the to-do plan to help the United States participate in the mining, the distribution, and the use of those minerals?
Tom, from day one of the administration, President Biden has talked about the need for us to diversify our critical minerals. And you're right, we have a need, and that need in lithium is probably the largest need that we have. According to the IEA, we're going to need 42 times the amount of lithium that we use today by 2050 if we're going to reach our goals. Right now, 2/3 of that is either processed or mined by China. So we have this need, we have a vulnerability. What we've done is one of the many things we've done about this is to create the mineral security partnerships. 13 partner countries plus the EU working together to share information about mining and processing, to invest jointly, to work on recycling, which is going to be about 10% of the EV battery content in about 10 years, according to the IEA. And we're going to do this observing the highest ESG principles, because what countries are telling us is that they do not want to choose between economic growth and environmental degradation. And we need to find ways to work with communities, with countries, so that they benefit from these kinds of investments. Lisa, and that's what we aim to do with the MSP.
Lisa, the heart of the matter here is China going to play by the rules as just stated by the Undersecretary?
Well, that's one of the issues. The other issue, Mr. Undersecretary, is it's probably difficult to present the view of the United States when it is so hotly contested, and we're dealing with strikes right now that really go to the core of some of the electric vehicle policies that we have in place. How difficult has it been to represent the U.S.'s view when the policy is sort of unclear and being contested by workers at home?
So there is great interest on the part of producing countries. I've been to several countries that are talking to us about critical minerals cooperation. Democratic Republic of the Congo, Zambia in Africa, Chile, Argentina, and so on. There is great interest, and no one is questioning our commitment, the Biden administration's commitment to clean energy. The IRA, the Inflation Reduction Act, is the latest example of that, and we will continue to pursue these clean energy policies.
Do you think that it makes the U.S. more secure or less secure in a world that still is very much tied to oil, as we have seen consistently? And when some of the production of the tools that go into electric vehicles have been tied to governments that aren't necessarily ones that are longstanding relationships with the U.S. and where the environmental practices of extracting those minerals is in question?
Look, we have to work on our vulnerabilities, no question about it. And it's not only having to do with critical minerals. You see the same or similar vulnerabilities in the case of vaccines, in the case of semiconductors. We all have vulnerabilities. We're working together with Europe in many of those vulnerabilities. In the critical mineral space, I will tell you that we have entered into conversations with many countries that want U.S. investment, and there is interest on the part of U.S. companies and companies elsewhere to work in these countries. So this is in the critical mineral space. This is a once in a generation opportunity for countries to actually use their resources and to do so in a way that's responsible and that benefits their people.
Jose, thanks for the update this morning. We appreciate it. Jose Fernandez there, the US Undersecretary of State for Economic Growth, Energy and the Environment. Lisa, every conversation we have at the moment on this particular topic, underlying just how difficult it is to make this transition at the moment. Throwing the UAW negotiations into the mix as well. There's nothing easy about this.
And then throwing in a government shutdown to boot, and you sort of wonder, where is the emphasis at a time where there's a huge disagreement around how quick this transition is going to be and exactly where the investment's going to come from?
My challenge here to the Undersecretary's good comments is their comments made in this righteous vacuum. They've got a theory, they've got a plan, and I don't see out there other nations really voicing the same theory as the United States. They're just like, get me the lithium.
Well, Europe's struggling to come up with its own plan.
Yeah.
And clearly there's some tension there as well, Tom, about what's happening in Europe at the moment.
Yeah. When we were in London, we got a real eyeball on this with the EVA, I don't even know what the right word is, the EV force that you saw in the United Kingdom. And the answer to me is, I wonder how alone we are on this debate.
We've got to push ahead to payrolls. Payrolls Friday just around the corner. Mike Dada of Roth MKM Partners is going to be joining us very shortly. Payrolls on Friday, TK. We thought maybe we might not get the data on Friday if we had a government shutdown. We know we will get that data now. What are we looking for on Friday, TK?
I'm looking for a jobs report that moves the market, and I'm not sure it will, because everybody's going to stagger to the inflation report. Frankly, with Jamie Dimon speaking to us today, Jamie Dimon's earnings report maybe has just as much weight as the jobs report.
October 13th for Jamie Dimon's earnings report. 165 is the estimate for payrolls on Friday. Live from New York City, this is Bloomberg.
Obviously, we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that because, you know, we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women. Like, what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
The boundaries of the entertainment world are blurry, and they're all scrambling for the same thing, screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business, converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at bloomberglive.com/screentime.
Coming off the back of 4 weeks of losses on the S&P 500, down on the week, down on the month, down on the quarter. Let's get Q4 going. Equity futures totally unchanged on the S&P 500. Where is your post-weekend pop? Government shutdown averted, no one cares. Nasdaq futures positive by 0.2%. In the bond market, huge moves on the quarter, on the month, on a 10-year, up by more than 70 basis points on a 10-year yield through 3Q. Just unbelievable. We kick off Q4, moving higher by 6 basis points, 462.89 on a 10-year, on a 2-year, up by 6 basis points to 5.1%. Tom, you're right, on a 30-year, long end of the curve, at 4 basis points, 4.74 on a 30-year in America.
I'm going to do that in every country as well. I'm going to look 10 out to 30s in the UK, Europe, and particularly in Japan, because out there's no YCC, there's no experiment, a toxic brew of economic theory, as you've got in the short side. But in America, and I haven't even looked, John, let me do it right now. You can do this on the Bloomberg Professional Service. Bank rate 30, Lisa taught me this, and I'm enjoying 7.74% with a 10-year and a 30-year up and away.
I'd suggest you're doing your best to avoid that. Yeah. I think most people are at the moment, Bramo. That's the story at the moment for bonds. Equities down for 4 weeks, yields higher for 4 weeks. The dollar coming off the back of its strongest quarter of the year so far. 11 weeks of euro weakness and dollar strength, taking the euro down to 105.35. We're negative here by 0.3%. That's some dollar strength. And here's some dollar strength too. Dollar yen, 149.69, very, very closely to here to 150, positive by 0.2%. Back end of last week, BOJ had a little nibble at the Japanese government bond market, threatening to do a little bit more.
It's going to be on Wednesday, supposedly, that there's going to be another bond purchasing operation, the 5 to 10-year denomination in Japan. This would be their 4th unscheduled bond buying operation since July. And it comes at a time where, and you've highlighted this really well, there's a push-pull with the currency and the bond market, and they are moving at odds with one another. If they support the bond market, they're basically going to weaken the currency. If they weaken the currency, they're going to lead to higher bond yields. They are kind of reaching an end game. And how much they want to tweak around the edges to make something more palatable that feels like it's increasingly unsustainable.
Do you suppose it's too early to draw conclusions about what their preference is, what their priorities are, based on the fact they've come in to support the bond market before they've come in to support foreign exchange?
I don't know. That is the answer. I don't know. It seems to me like they're just kind of like spinning plates. They're like, all right, over here, we're going to try to figure this out and keep things just kind of here and not moving too quickly before they can really come to some sort of true set policy. It's almost like they're biding time. And I don't know that they're choosing one or the other. They're just kind of trying to play them off each other.
Strategic ambiguity, maybe? Japanese policy, something like that.
I think so.
If there's a strategy there, I've got no idea if there actually is.